I mean, for what it's worth, we're still holding on to that call that the official recession will start this year, and the only alternative we're seeing people move towards is gold. But that hasn't like weakened the dollar on its own terms. It's just pushed the gold price up in all currency terms. If you get global central banks just upping their gold holdings by 1% as a share of reserves, you basically buy an entire year of annual gold production. You know, we would describe ourselves as overweight on the complex generally compared to historically.
All right, Dylan, you work with David Rosenberg, someone who wasn't very bullish, to put it mildly, last time I spoke to him. But also, actually, since I spoke to him, the market sort of keeps ticking higher. Economic indicators on the surface are looking good. Interest rates are supposedly going to start falling soon. So all is well with the world, is it not?
Well, not particularly bullish is a good way to describe Dave, although if you want our gold view, you're described as very bullish, and I'm sure we'll get into that before too long. But, you know, I think it's true that we've been surprised by the strength of the US economy, in particular over the last, call it 12 to 18 months. We were in a lot of company going into 2023 when we were predicting a recession, and we found ourselves in a dwindling group who think it is still around the corner. I can quickly outline, you know, what we see as the reasons for that. But the overall picture, I think, is that there have been a lot of transitory forces which have kept consumption high, especially personal consumption, a lot higher than we would have expected. But as we dig into those forces more and more, I will happily admit that we didn't see them coming, but we also don't see them as being something permanent or structural. And if you look at the kind of data flow that we've seen in the last just sort of 2 or 3 weeks, it's sort of switched very negative compared to expectations. You've got the Bloomberg Surprise Index, the City Surprise Index, both switching from, you know, running positive, so people being constantly surprised to the upside for a long time, and switching very, very sharply negative recently. So I think there is something of a coming down to earth underway. And the question is, you know, is that just a softening that leads us to kind of below trend outcomes for a little bit, or is there more fundamental cracks opening up? That's something we can definitely explore a little.
I suppose my question really is how come? Like, why are we doing better than not? And sort of translating into my 5-year-old brain, that it pretty much seems like it's all money printing, to put it mildly. Is that to put it simply? Is that kind of the case? What do you think?
You know, I think central banks have played their role, but, you know, if anything, the banks have been so tight that it's hard to say that there's been a sort of outright monetary financing of the government going on. But I think you're hitting on something completely correct, which is that the U.S. government is you know, one of the big culprits behind these upside surprises and data that we're seeing, and the supposed strength of the U.S. economy. So maybe just to kind of set the picture there, cast your mind back to when we came out of COVID. We had this enormous stock of excess savings, we started calling it, from that people had accumulated, essentially from you know, being able to mostly, especially in the service sector, still draw a salary, but have expenses completely collapse, right, with no travel happening, not paying for gas, all that kind of stuff. And so a lot of people built up a stock of savings. A lot of that went into assets, houses, and stocks. So we saw that big COVID bubble happening. But a lot of it was also accessible and liquid. And what we saw happening in the kind of 2 years after the pandemic, which really kept growth strong, was people spending down all these excess savings. When they ran out, people going onto credit cards. And a lot of that also came from the fact that people had been given free money, essentially, from the government. Now, the bit that we didn't really see coming was what happened after that. After those excess savings were spent down, we saw the economy kind of softening in the second half of 2022 and looking quite weak to start 2023. And what the US government basically did was say, oh boy, this looks like it could be bad, and started spending hand over fist. Not in terms of kind of direct transfers, but just on all sorts of programs. Some of the stuff we've been seeing in legislature, infrastructure, and spending, all of that, but also just normal program expenditure went up massively. And that trickled its way into the broader economy, not just directly, but also indirectly. People tend to spend more when that happens. And so you got an extra boost from just from the US, from the government there. And the final effect, which I think is trailing off now, but which we saw sustained growth in the early part of this year, is a very big wealth effect. So that part of the income distribution in America that is sitting on assets, that is invested in the stock market, that does own their house, has seen enormous growth in wealth. And they have been able to access the returns on that wealth, access the wealth directly in order to keep up with spending. So, Granny with a 401k is buying the family a trip to Disneyland, whereas if stocks were down 10% instead of up 30, that sort of spending wouldn't be happening. Right? So all these forces have been, and part of the clue here is that the US has been massively outperforming the rest of the world, which tells you something different has been happening in the US. And these are all the big differences that we see, right? Those excess savings in places like Europe, Canada, Australia aren't being spent down because people are worried about upcoming expenses. In a lot of places, mortgage bills are about to roll over, and people are going to see their discretionary income absolutely eviscerated when they re-index to higher interest rates. Not a problem in the US, where a lot of people have 30-year mortgages. The amount of government spending just hasn't been as high in the rest of the world, and so that impulse hasn't been there. There's been a bit of a wealth effect, but consumers there are less leveraged to the stock market than they are in the US. So we think that's what's kind of been happening for the last little while. Now, very difficult to say how far a tech-driven kind of frothy stock market can keep going up for, so that piece of the wealth effect there might stick around for a little bit. Although we think when something does trigger a downturn, it'll be pretty hard and probably go through correction territory into a bear market, but who knows on the timing. But those other forces aren't there to stay, right? Government spending can't keep increasing to give a growth impulse to the economy. There just isn't enough headroom. So once we're through the election, that disappears pretty quickly, we think. Consumers are only saving about 3% of their income, so they can't save much less. So again, there's less impulse to come from there. And we're seeing in this latest earnings reports, the type of results that you usually get when consumer buying power is eroding. So Walmart is up massively, and most of the rest of the retailers are down. That tells you there's a lot of trading down going on. We've got McDonald's bringing back $5 meals, all sorts of things that fairly obviously tell you that people are running out of juice a little bit, especially on the lower end of the income distribution where that wealth effect isn't at play.
Well, I can confirm that there's a difference between the rest of the world, because my granny certainly ain't taking me to Disneyland, unfortunately. But
mine neither here in Canada.
That's because of the accent. If you had an American accent or a North American accent, she would. But if it's what I'm thinking about when I say money printing, I'm thinking mostly about long term, sort of Bernanke till now. And what I'm thinking about is, if it is money printing, why couldn't this be sort of a permanent increase in asset prices? Like, do they have to deflate from here on?
Well, yeah. So I think that there's a lot to that, right? But it's unquestionably true that the amount of liquidity sloshing around the financial system since the GFC is, orders of magnitude higher than what it was before, and that's had to go somewhere. And I think that's explained this long-term divergence you've seen, not just in the US, but in a lot of places, between kind of stores of value and the real economy, right? Where we've had stock markets soaring relative to GDP. We've had the same thing happening in house prices. Those are the two main ones. And so I think that's all kind of real. Now, central banks have been trying to pull a bit of liquidity out of the system more recently with quantitative tightening. We had a bit of a round of it before COVID, but it's been much, and then obviously got another massive expansion of balance sheets afterwards. Interest rates floored, all of the stuff negatively correlated with interest rates and with liquidity all soaring. And that hasn't quite reset, although that 2022 kind of correction that we saw in markets actually was correlated with the start of tightening or the anticipation of the start of tightening. So, but the target for where central bank liquidity will end up is a lot higher than the kind of central bank balance sheet to GDP ratios were before. So I think you're right to say that we're in kind of a new world in liquidity terms. I've heard a lot of arguments to say that, well, we were short liquidity beforehand, so we're actually getting kind of more towards where we should be. And ultimately, markets will tell central banks in the long term how much liquidity they need, because if too much liquidity gets drawn out the system, then overnight markets start to fracture up a little bit, and banks start to struggle. So we'll see where that lands up. But it's one of these things that economists love to obsess about the difference between levels and changes, right? So just because I do think that there's enough liquidity in the system to say that a lot of the gains we've seen in equities and house prices are not going to completely disappear again, and we're going to rebase to a kind of 2007 world or 2010 world. But does that mean that a bull run in equities should continue while M2 growth is negative and a lot of liquidity is being pulled out the system and interest rates are incredibly high relative to where they've been, and also tight relative to inflation, so real rates are positive and quite high, above neutral? The answer to all of those is no. Meanwhile, we're seeing a stock market that is stretched in terms of valuations, and it's top sort of 10% of the distribution historically. And we're also seeing it as concentrated as it's been since just before the dot-com bubble. So those things are saying, yes, there is a broad increase in liquidity, but we're still sort of out of the range of normal in terms of where valuations are.
I also wonder if there really is another option to increasing liquidity. Like, it seems like that's pretty much the only option, because so far the Fed has pretty much always come into at the slightest whiff of a dysfunction in the market, specifically when it's related to the bond market too. Obviously, they've just come in to save the day. So what do you think would have to happen for them to as it were, stop coming in to save the day?
Yeah, I wish I had an answer for that. I mean, what it would take is a central banker with incredible spine. And what that person would need, I don't think that person is there right now, but what that person would need is an accumulation of evidence that basically says, look, we've built up a mode of operating which is more costly than the benefits that it brings. And I don't think that's the consensus view certainly among academic economists, definitely not among central bank economists. I think the view that probably predominates there is to say, look, we know there are some downsides to the enormous balance sheet expansion that we did. It led to a run up in asset prices. It's probably increased inequality on the margin. Increased inequality on the margin. And there are some concerns over kind of how we normalize and so on. But remember what it felt like in December 2008. Remember what it felt like when COVID hit. Like, we had no choice but to take bold, aggressive action. And we can, the other problems we're facing as a result are A, smaller, and B, more fixable. And so I think people who expect the Fed to step in are completely right to think that, because that's basically what they've taught us to think. Now, those two things, the GFC, which was not a normal recession, it was a banking crisis, and historically banking crises are less frequent, but also always much worse than other types of recessions. And COVID obviously was almost unprecedented as a downturn. It's just shutting down huge sections of the economy. So you could argue those were extremely special events, and a normal recession would not trigger a big easing cycle. I think that's true, right? If we get the kind of recession that we're expecting, which is a kind of normal cyclical recession that you'd expect from a change in consumption patterns, people holding onto their cash a bit more, spending less, labor markets cracking up, people being worried about their jobs, and probably associated with the downturn in markets too. But nothing sort of so deeply structural as the banking system collapsing, then you probably would see a more normal reaction function from the Fed, which is just to say, okay, we're going to slam rates into accommodative territory, so pretty quick cutting. We're probably going to stop quantitative tightening, but we're not going to increase the balance sheet because we're not against the zero lower bound yet. And until that crisis became something much deeper, they probably wouldn't do that. That is my expectation. On the other hand, they did not allow any banks to fail in the regional banking crisis. They stepped in and immediately recapitalized them. But I do think that, again, although it sort of increases overall size of the central bank's balance sheet, it's not the same instrument as broad QE. They're not funding the government. They're not buying bonds. They're saying, okay, we have macroprudential tools to allow for orderly resolution of these banking issues. We pump some liquidity in, but we actually end up kind of resolving that fairly smoothly, and the rest of the economy takes along. So they would think of that as a different sort of thing.
When you say bold, aggressive action, like sort of the equivalent that pops into my brain is basically money printing. That's what I imagine when you say bold, aggressive action again. And I am putting it very simply so that I even can understand it. But when you talk about QT, I'm reminded that the way QT has been done, where it's much more passive than it is active right now, right? As in there aren't any sales of assets of the Fed's balance sheet. It's a very, very slow reduction of the size of the balance sheet through letting IOUs expire off of it, basically, and then trying to tighten consumption through monetary policy as opposed to through fiscal policy more aggressively. That's not really worked, right? Inflation is not 2%. Arguably, it's mostly hurt the size of the interest expense for the government because a lot of consumers had locked in interest rates and so on and so forth. So the question is, why? Like, why are they not more aggressive now? And can this be the soft landing everyone was hoping for? Because, yeah, I mean, let's start there. Why are they not more aggressive?
Why not tighten much more aggressively through the balance sheet side? The explanation for that comes from what happened in 2018 when the pace of quantitative tightening, the first time it was tried, was quite a lot sharper. And so they were actively selling instruments, and the balance sheet was shrinking at a more rapid rate. Now, what happened was there's on the other side of the balance sheet to the Fed's assets is you have liabilities and various overnight facilities that banks use to access overnight liquidity. This is where it gets a bit technical. But essentially, when you sell down the asset side of the balance sheet, you get a natural and necessary reduction in the liability side of the balance sheet too. And that basically dried up liquidity for the banking system. And you got these sharp variations in overnight interest rates, which actually undermined interest rate policy, right? The Fed sort of was getting worried about losing control of the overnight interest rates, which are what they use to conduct their main policy tool, which is monetary policy, right? So they looked at that episode and said, okay, no need to shrink the balance sheet quite that quickly. If we want to respond to inflation, we can just do aggressive interest rate increases, and we'll let the balance sheet reduction happen in the background, which is, kind of what a lot of people argue is what should happen, because it doesn't sharply affect asset prices. It doesn't lead to, a big spike on the long end of the yield curve or something like that, which would probably over tighten things a little bit. So it just happens in the background. And what they're trying to get back to is normal monetary policy operation, when they say, don't worry about the balance sheet. No one thought about the balance sheet in 2003. Look at the interest rate settings. That will tell you how tight or loose we are. Now, inflation has come down, but we can have a long argument about what caused inflation, what the appropriate response was, what the trajectory of inflation is, what actual inflation is compared to what the CPI is telling us, which is a flawed indicator. But broadly, they've been successful in keeping expectations anchored. So we don't have people thinking inflation is going to run 5% for 5 years, which would really cause long-term deviations from target, which would be intolerable to the central bank and to everyone, frankly. So as the supply chain shock passed through, and we've had some knock-on into services prices and so on, but we haven't had a 1970s, 80s style like de-anchoring where everyone thinks inflation is going to be high forever. I think broadly everyone thinks it's going to be below 3% in a 1, 2, 3 year horizon.
Do you think that?
Yeah.
Okay. When you say that the Fed should go back to or could go back to normal MO, prior Bernanke's Nobel Prize winning invention, which is, say, QE, what is that? What's the path to normal MO is what I'm asking here.
I think, unfortunately, Pandora's box is open on that, because once you've used QE, it's there as a tool. It's available. People will be calling for it. in a downturn and so on. So I think it is just the case that the central bank now has more than one way of responding to the economic environment. Now, what they're trying very, very hard to do is to say that is an incredibly exceptional tool that we only deploy in sort of extreme circumstances, and stop thinking about a Fed put, stop thinking about us doing that through the normal business cycle. We really just want to use interest rates to manage that part of the economy. But I think that's very difficult for them to do, having used it sort of, I mean, if you combine all the post-crisis episodes, having used it, twice in a big way in the past less than 15 years. So I don't think the way is all the way back, but I think, as I said earlier, what will help them is if we do get another downturn, another recession, they don't change balance sheet policy in a big way. They don't use the balance sheet as a tool to respond to that. I think that will start teaching people that maybe it is an exceptional tool, and maybe we are heading towards a more normalized liquidity situation.
Well, but what did an exception that lasted 15 years?
Or more circumstantial, right? Like an exception that, okay, if there's another massive pandemic and we need to, basically every time we hit the lower bound, this tool comes into play, right? But until interest rates are at zero and we still want to provide more accommodation to the economy, we're not touching the balance sheet.
So, but you do think we're going back to ZIRP first?
I don't think so. I think look, real neutral interest rates, it's very, very hard to estimate, but they're probably somewhere just over 2%. So if we do get another crisis and say inflation's at 2%, okay, so to get genuinely accommodative, you need to go all the way down. But if it's a mild enough recession, I don't think they would do that, right? So depending on how heavily things take a downturn, they may need to, but I think again it would take a more sustained situation or more crisis-like feeling in whatever part of the economy for them to do that. I think they're getting a little bit more aware of the costs and that this can't go on. And the other thing that's different, by the way, is that they haven't conducted this type of policy with government debt standing over 120% of GDP. And there are real concerns that there's just too high of a debt stock and not enough in markets and too much sitting on the central bank balance sheet. And so they'd be worrying about the sort of fiscal implications of that as well.
Would your opinion change based on who wins the elections and who becomes and who's going to run the Fed actually over the next couple of years? Because, yeah, let's start there. There's more to be said about that, but would your opinion change based on who wins the election?
I mean, Trump's been saying for a long time that the Fed's not independent enough, blah, blah, blah. The Fed's too independent, and that's a problem. And but the nature of his attack, of course, because he's Trump, changes a lot. Sometimes it's rates are too high, sometimes rates are too low. So probably not. It is a very strong institution. It tends to make people its own, and we probably would get a change in the Fed chair. It might be someone. There's various names floating around, but none of those names are kind of consistent with Trump's own behavior, right? Probably the people he's mentioning, people like Laffer, who are really, really hawkish. Trump's a low rates guy. He's from the property sector. He judges his success by the S&P 500. He doesn't want high interest rates. He doesn't want tight accommodation. If the economy takes a downturn, he wants everything to be done to get it right again. He wants to deliver tax cuts and block his ears on the rest of the fiscal position. He's not a long-term thinker in that sense. So I don't think we're going to see a big improvement or a big hawkish tilt in Fed policy if Trump does. When in fact, I think probably the pressure he would exert would go in the other direction. But I also think, in the list of sort of things that are easy for him to go in and get done, messing with Fed independence is pretty far down the list. So I think that's all kind of overblown.
Is this really about the S&P or property sector or whatnot, or is it mostly about the strength of the dollar? Because Jerome Powell seems to be just very in favor of a strong currency, and there's been a lot of talks about potentially a currency war and who's going to blink first and this and that. So isn't this mostly about the dollar?
Yeah, I wouldn't. It's about whatever's annoying Trump at the moment, I think. if a weak dollar proved to be highly inflationary, I think he'd be worried about inflation. He's worried about what's affecting the polls. Strong dollar, I don't think Powell's like in favor of a strong dollar. I don't, but I think he sees his mandate as being getting inflation back to where it needs to be. And if the cost of that is a strong dollar for a while, then so be it. And once he can reduce rates and get inflation to where headline inflation to where he wants to see it, then he's happy to accommodate a weaker dollar. So, I think the strong dollar is more of a byproduct of what's going on in the U.S. than an active target. Can Trump do a lot to weaken the dollar without the Fed playing ball? Probably not. In fact, he'd probably have to weaken the economy to weaken the dollar with high interest rates, which is not something you want to do. So, yeah, otherwise there's trade policy, there's tariffs, all that kind of stuff. But I think we can expect an escalation in those trade wars. But it's not clear a priori which way that pushes global exchange rates.
Well, but another, or I suppose the more obvious way, given that I'm coming up with it, about what could weaken the dollar is lower interest rates in the US, but don't lower interest rates over here in the EU.
Yeah, exactly. And I mean, what we're seeing right now is markets probably correctly pricing in interest rate cuts coming in much sooner in the EU. Well, not much, but definitely sooner and a bit deeper in the EU and in Canada, which are the main constituents of the DXY. And that's what's got the dollar strong. So it's going to take a readjustment of those interest rate margins to weaken the dollar again. And until the US economy slows down a little more and inflation comes down a little more and gives the Fed space to cut, that's just going to be the case.
That's basically the only or the main reason why I care about any of this really is the relative strength of the dollar. So yeah, I mean, knowing all of this, knowing all of what you told me so far, what's that telling you about the fate of the dollar, both medium term, what you just told me, but also just long term? You see all these conversations or YouTube videos or whatnot about the dollar being on its deathbed, dying and whatnot. Is that what you think is going to happen long term too?
Mm-hmm. No, it's not. I think that view is pretty overcooked, and I'm fairly happy to push back against it. I think the one aspect of what's correct about that view is that there is less of a global appetite, both officially and in retail sectors in certain countries, to hold dollar and dollar-denominated assets. So I think that is why we're seeing the gold price explode. We're seeing Chinese consumers, the Chinese central bank, Indian consumers, Turkish consumers, and sort of official banks everywhere shifting their mix of assets a little bit to sort of away from the dollar and towards the only actual alternative as a long-term store of value that's relatively safe, which is gold. If you remember, if we were having this conversation 10 years ago, it would be along the lines of, will the renminbi emerge as another global reserve currency to fight the dollar? And does that mean the death of the dollar? Well, it turns out it actually, that competition meant the death of the renminbi as a global reserve currency. No one wants to hold that in a world where there is total fragmentation between the US and China. In fact, on the margin, it's probably strengthened the dollar's case as the only actual currency that is a genuine global reserve currency, right? And the only alternative we're seeing people move towards is gold, but that hasn't like weakened the dollar on its own terms. It's just pushed the gold price up in all currency terms. I don't think cryptocurrencies are a real alternative, and so I think the dollar remains the global reserve currency, and the dollar remains the global currency of trade. And so that gives it roughly the same role it's always had, albeit in a much more complicated world. So no, we don't think the dollar loses a ton of value long term. But the current strength, the current overvaluation of the dollar does have a lot to do with just where interest rate settings are and where the relative cycles are between the US and the rest of the world. And it's just reflecting a huge amount of US economic strength at the moment, which we're waiting either for Europe to bottom out and come back up, for China to bottom out and come back up, or for the US to slow down a bit in relative terms, and then we get a rebalancing to more normal pricing.
When you say the current overvaluation of the dollar, how do you measure that? Is that the DXY that you're talking about?
Yeah, I mean, pretty much all the index measures that you could have are telling you the same story, which is that, the dollar's pretty far outside of its normal range right now in terms of how strong it is. You could also look at it in sort of like purchasing power terms or real terms. All of it is telling you that the dollar is pretty strong. So it's not like one measure is sending that signal, but the baseline is DXY and that's at record highs, right? So
Hmm. What do you mean in terms of purchasing power? I mean, you see all these things on Twitter where purchasing power is just getting worse and worse over the generation. So how is the dollar's purchasing power now higher than it was before?
well, what a dollar buys you in other places, basically. So
Okay.
as
So the Big
inflation
Mac
becomes,
index.
yeah, exactly,
Okay.
exactly. Yeah, as inflation becomes more controlled in different places around the world, generally in EMs, those relationships are stabilizing, but the dollar's still getting you much more than it used to in a lot of places.
Hmm. So, but the dynamic of what's bearish for the dollar is bullish for gold. Do you think that's going to remain?
Well, that's a really interesting question. Um, and I think you have to start from the observation that the dollar has been very, very strong. Uh, and US inflation has been coming down.
Hmm.
Uh, and yet the gold price has been performing incredibly well. So something has changed from the usual long-term relationships, or something has become more powerful than the usual long-term relationships. We've also, by the way, seen recent outflows from ETFs. I'm sure you've talked about this a whole lot. I don't think it's that something's changed in the relationship between the two. I do still think that that actually has been something that is holding down the gold price in terms of the contribution of US and Western markets to the gold price. I just think what's become much, much, much more powerful is the role of basically East Asia and the EM world in setting the gold price, right? So as interest has waned a little bit in the West, it's been very much picked up outside of that. We see huge speculation and a huge retail interest in China. Gold is becoming a very standard part of assets among the wealthy in a lot of EMs who want to diversify, as we've spoken a bit, off dollars and certainly off domestic currency. And then central banks have been slowly upping their gold holdings as a share of reserves. And as we've said, reserves are a lot higher than they used to be. And it doesn't take much. I've been surprised by the scale here. Like if you get global central banks just upping their gold holdings by 1% as a share of reserves, you basically buy an entire year of annual gold production.
Hmm.
So it is a massive and very powerful source of support for the gold price that's been underlooked. And so those factors are all essentially just overpowering the traditional determinants of the gold price, which is why we actually have the view out there that once you do get rates coming down in the US and inflation falls a little further and the traditional relationships reestablish and you get a slightly bigger dollar, you're going to see a few more legs up in the gold price. So that's why we have a 3,000 target, because we think the macro actually is lining up for more support.
So that traditional dynamic has been broken due to basically supply and demand fundamentals for gold, but you do expect it to come back rather sooner than. But what's the timeline for it going back to normal, where the dollar's dropping, gold's going up?
The timeline is the timing and severity of the US recession, which, there's an old saying in economics that you can predict the direction of something or you can predict the timing of something, but never both. And so, we still think that the data are telling us that a US recession is kind of imminent. The headline numbers have not lined up to enable the Fed to cut the dollar to weaken, et cetera, to kind of trigger those kinds of dynamics in the gold price. But when that US downturn does happen, that's when we're going to see, I think, another leg in the gold rally.
That
The
US
other thing, of
downturn.
course, sorry, I was just going to say the other thing, of course, that's always there is geopolitics, the effect of geopolitics. That could be something that triggers very easily.
In terms of sort of the fear demand for gold, then in that case.
Exactly. Yeah.
Okay. That downturn or recession that you're talking about has remained sort of elusive for quite a while now. So is that making it harder for you to predict the timing of it? Like, you know that I mean, well, eventually it's going to have to come, but how actionable of an advice is that in terms of portfolio building?
Yeah, fair enough. That's very tricky. I mean, for what it's worth, we're still holding on to that call that the official recession will start this year. Um, Now, there's a few things that make that extra challenging. One is that recessions are only actually declared more than half a year after the recession happens and up to a year and a half after the recession happens. And one thing that we think is making it quite difficult at the moment is the degree of revision we think is going to happen to the official data. Right? So this often happens around big turning points, but you get the data surprising to the upside for a while, and then once the benchmark revisions come in, and this is true of labor market, it's true of GDP, it's true of a bunch of stuff. You actually get large downward revisions, which tell you, oh, we were actually in a recession. The recession was starting 6 months earlier before we all thought, etc. And one data point just to back that up is in the US, there's this sort of half unknown indicator called the quarterly QCEW. So the census does a measure of unemployment where they basically survey every single actual business in the US, right? So it's like 12 million data points compared to 700,000 in the LFS, which is the normal unemployment indicator. It's very laggy because it takes so long to collect, but it tells us that in Q3 of last year, there was no employment growth at all. And Q on Q in Q3, the labor force survey tells us there was like almost a record amount of employment growth. Something's up, something's broken. And we think that's one indicator to tell us a lot of downward revisions are coming. Labor markets are not as strong as they look. And even though we've seen them soften recently, we think there has been more softening than has been acknowledged. So that's one thing lining up behind it. The other thing is all these temporary forces I was talking about keeping GDP growth going. And those two things together, I think, in the next quarter or two will soften even more. And I think that's where it comes from. So I don't want to tell you which quarter it will happen, but we're very much kind of in the period now where we're looking for it.
Do you think there's going to be the era of where gold is outperforming mainstream equities? But and when I say era, I almost mean it. Like, is it going to be a meaningful period where gold is outperforming, or is it just going to be like historically, it's a brief period of time where gold's outperforming, and then it goes back to ever bullish U.S. equities?
Yeah, I think I think era is going to be a strong word. I think there will be a period of gold outperformance. I do think we're going to see things happen kind of all at once in the US increasingly. Like, they've been sort of building these imbalances, and I think it's going to take a couple of data points, but I think everything's going to happen sort of all in one go. Everyone's going to realize there's a lot more economic weakness than we think. The Fed's going to start going, equity is going to collapse. Like, I think that all is going to happen in kind of a very short space of time. And that in and of itself is going to be very gold positive. So I think from there, you're going to start seeing gold outperform. But I think, as usual, once you get the sort of correction and bottoming on the equity market, that triggers a period of equity outperformance always. Like, look at how good 2009 was, look how good 2021 was, or late 2020 even. So I think that's a fairly typical cycle that we probably can expect.
Well, that's going to be good for media, I suppose, and for social media engagement, because we're going to see a lot of that happening. If we do indeed enter that kind of a phase, though, do you think the traditional sort of 60-40 portfolio, respectively stocks and bonds, could be replaced by a 60-40 stocks gold portfolio?
No. Leaving aside the fact that like all the whole financial system is benchmarked around the 60-40, and it's like got such a deep place there. I actually think we're due around a bond outperformance at the same time. Bonds have been underperforming, obviously, for obvious reasons, very badly in the last couple of years. But once you get US rates starting to go down, I think that's going to trigger a period of bond outperformance roughly at the same time that we're just talking about, where the equity market's down, gold's up, probably you'll see equity market down, and bond markets doing very well. the 10-year rate has to get probably 1% lower in this recessionary scenario. Right? So total return from that, given the duration effect and so on, is actually very appealing. So I think that's actually the time when the 40% does its job. So no, I don't think so. But what I think we will see, and which we've argued for actually, is better diversified benchmarks. And given where we see gold going, for the standard formula to be, a different balance, but which includes gold holdings in it as well, right? To be the standard benchmark. So I wouldn't switch out bonds, but I definitely introduce a place for gold.
Wouldn't that, I mean, you're thinking that bonds are going to go up basically from here on. Wouldn't that contradict your belief that inflation is defeated basically?
Yeah, but remember when rates come down, bond prices go up, right? So the total return on bonds gets a huge kick basically from the valuation side of it. So even as rate returns come down, you get the valuation effect. And so during a cutting cycle, bonds outperform.
But you do need demand for bonds to outperform, right? Who do you think is going to be buying those bonds, basically?
Well, it doesn't change the issuance picture, right? So I think the either way, the U.S. government is issuing what it's issuing, and there's a big global bid on U.S. Treasuries that, although it's stopped growing, there is still enormous demand for U.S. securities. It's still the benchmark safe asset, and there are still concerns in other places that there may be too few out there. So we're not too concerned about the kind of bid for Treasuries drying up, but there's sort of mechanical effect of lower interest rates generally picking up bond prices on issuance, and so that happens all along the curve. But also you get the fact that people tend to run to safer sources of income when you have the economy doing a downturn and your equity markets doing a downturn. It makes the relative case for bonds much more appealing as well. So in this kind of scenario, there's all sorts of avenues for increased fixed income demand.
Okay, it'd definitely be interesting to finally see bonds going up because I've been hearing about this bond bull market forever, and again, also hasn't happened. And I appreciate sort of the use of historical happenings here. Yet I wonder if things might be, and I know that's dangerous, but if I wonder if things might be in some aspects or corners of the market different because of the presence or the existence of ETFs, or the popularity of ETFs, which wasn't the case, going back to Bernanke again. What do you make of that?
So the question there is, would equities performance be different in this kind of macro scenario we've set out?
Yeah.
Yeah. Possible. I mean, look, it's very true that ETF demand has been kind of increasingly becoming the big marginal driver of prices. There's been arguments around the fact that because of the weighting systems of a lot of ETFs, it's like increasing concentration actually, or it's increasing, the dominance of the tech sector. But no, I think there are still fundamentals beneath that in terms of flows that do mean that markets can and do go down, and that they can and do go down for reasons related to kind of what the macroeconomic situation is, right? Not least the fact that people start to liquidate, whether they're holding ETFs or individual stocks, when their risk appetite massively changes. And so if you're seeing that kind of scenario emerge, or you're seeing people think, okay, there's a cutting cycle and it's actually going to happen, bonds are much more appealing, I'm going to shift 20% of my allocation over, that is an outflow from the equity market. And whether it's implemented through ETFs or active managers, it's still the case that it brings the market down. So, I think we do have some concerns around how ETFs shape sort of the day-to-day in equity markets, but those fundamental cyclical forces I don't think are too much affected.
Do you think they're affecting gold equities though? And what gold equities go up are basically the equities that are part of the big ETFs. That's kind of what I've noticed so far.
Oh, that's an interesting point. Yeah. Yeah, I do think that type of index support, yeah, it's a case of, your boat can still be lifted a bit, even when you are in a sectoral challenge, right? there's enough. Remember, the price is set by the marginal buyer, though. So I do think there's enough active management out there to still drive fluctuations. But I think, but I do think these sorts of effects are there. I mean, if anything, I'd frame that as a very strong active opportunity if you think, that ETFs are leading to mispricings because the market has become too correlated with itself. In a sort of major economic event or a major industry event, that correlation has to break down. And that's actually quite a good opportunity, I think, to move around, to make some plays. And so I think if you think gold is going to diverge from its usual path here, and that's positive for the gold miners, but the index is driving that price too much, I think that A is worth more research and B quite appealing.
So you basically think there's an opportunity to be more active in managing your portfolio and picking specific names instead of going for the gold ETFs?
If you think that the ETFs are taking too long to pull the signal in, then yes.
Okay. So is that going to change? I mean, and I've brought it up a couple of times, but since Bernanke, we've seen, an increase in passive investments. Is that going to change? I mean, is that going to go back to the MO of actively managed portfolios?
No, I don't think so. I think it's too easy, it's too cheap, and it's too embedded for a lot of people. It's the easiest way to access the market. It's probably coming towards the end of its like extreme growth phase. And it probably will settle down, and you're seeing the actives being able to make a bit more of a pitch, I think, as the index becomes so dominant. But I don't think it's going away. That said, in terms of gold ETFs, I mean, the point that's a bit more interesting there is just how big the outflows have been in recent times, even though the gold price has been going berserk. So I think there is something strange in kind of Western perceptions of the gold market and perceptions of portfolio managers that here. And I think what it is usually, as we've discussed, if you believe in higher for longer and higher interest rates and cash yielding more than it usually does, well, that's very bad for gold. And so that thesis is very much being applied via the ETFs, and that's why we're seeing all those outflows. When that view reverses, I don't think it's going to matter if you go active or passive in terms of implementing it, but maybe the active kind of picks it up a little more quickly as the index takes longer to readjust. So possibly one thing.
Where does silver come into this mix, though, then? Because I'm thinking about it, silver being sort of a double-edged sword, if you will, where it's got an industrial side of it, but then it also has a safe haven side of it, arguably. So where does it come into your mix?
Yeah, silver, we looked at this a little while ago, and I mean, silver did look like it had a leg to catch up on in terms of gold. So we were pretty bullish on silver, and I think that's largely been playing out over the last little while. But you're completely right. There's a big industrial component to silver that has been kind of moving in the opposite direction. Now, there are rumors out there that we have not been seeing a US recession or a global recession, but we have unquestionably been seeing a manufacturing sector recession, industrial sector recession. And that has been holding down prices of all sorts of things for a while, which are now kind of re-emerging. We're seeing copper really go on a run. And silver probably similarly has those tailwinds to benefit. So it does look like as that bottoming out happens in the global kind of capacity cycle, and all that excess capacity that has emerged after the supply chain issues from COVID has come off. I think the worst of that is through, and the effect that that's had in terms of holding down the silver price is probably now washing out. And you've got the speculative and the safe haven gold-related element of silver demand still looking very positive. Meanwhile, less of a drag from the industrial side probably emerging. Now, I know that's not fully consistent with our US recession view, but again, this is more of a supply side versus demand side argument we're having here, which is US consumer demand is going to start falling off there. But at the same time, the global production industry has been healing itself over the last little while. It's in more of a position to manufacture efficiently.
Is there another metal that you have a comparable opinion on, or is it specifically silver and copper in this case that you're focusing on?
Yeah, look, I mean, we've had a long uranium for a long time. We think there's very interesting things playing out in that industry, and it does look like this era of sort of nonsensical denuclearization in terms of the power supplies has diminished. And if you look at how to get to a lot of the energy targets and the carbonization targets for the next, or decarbonization for the next 10 years, the path to that without actually quite considerable contribution from nuclear energy is very challenging. And so we think there's a strong and sustained source of demand there. We've got, just in my backyard in Ontario, there's a bunch more nuclear projects starting, and we think, Germany's kind of stopped its denuclearization, and a lot of places are looking at increasing it. And so I think that's an important tailwind for uranium. Meanwhile, you've had the kind of supply issues that kept the price very high for a while. So that's playing out very nicely. Otherwise, not a strong view sort of on the industrial block as we have on the precious metals. It's still challenging to call on a kind of, as we say, we think there's trouble coming for the US, which is weighs on demand, but also you've got kind of the supply side factors looking a little more constructive in price terms. So difficult to draw the balance there, kind of metal by metal, and so we don't have super strong views out there. But transition metals more generally, nickel and lithium, we're fairly positive about. We think a lot of the worst is behind us there on those. We've had the sort of tank and EV demand, but that's a very structural, very long-term view. That battery demand is not going anywhere. And so we feel very positive about those two.
And that's irrespective of what happens over the short run in the economy, I suppose.
That's a longer term hold. Yeah, that is much longer term.
Okay. But what kind of an exposure are we talking about here? Because we spoke about the 60-40 portfolio. What percentage of your guys' model portfolios or portfolios are exposed to the commodity complex?
Yeah, I mean, we don't do explicit allocations, but we would describe ourselves as overweight on the complex generally, compared to historically.
Well, that's a very good note to end it on, I suppose. But Dylan, this has been great. First time we're speaking. I did enjoy it. I like your overview. Took a bunch of notes. What am I forgetting to ask you though? What did you come here hoping to talk about that I'm failing to bring up?
I think we hit all the big ones for sure. Lots of good macro chat. I think we got most of our views out there. If people didn't get too tired of my voice, we do have a weekly podcast where we talk about kind of the latest in macro called the Rosenberg Roundup. That's me and my colleague Jacob hosting that. So that's on Apple and Spotify if you are interested. And of course, just shoot us a note if you have any extra questions.
All right, Dylan. Well, thanks again for doing this. I did enjoy our conversation. Hopefully we can talk in a few months and still be wondering about where the recession is, because I'd rather it didn't come. But I'll let you drop off now, as I'll be moving to the CEO barbecue portion of today's Real Money Talks. But of course, as always, fair disclaimer and an honest confession. First of all, it's no secret that here at Resource Talks, we like to be different by specifically not hating you. Unfortunately, that is kind of a change in the YouTube verse. What that means specifically is that I would like you to be aware of the fact that although none of the companies that you see here have paid me for the production of their interviews, they do have active marketing campaigns, and they are likely here as part of their marketing campaigns. Be aware of that. And just be aware of the fact that typically, although again, these two have not paid the production of this interview, this channel and other channels who do interview CEOs, we earn money by charging for the creation and publication of these interviews, right? Even though some will try to hide away from that, there's a little disclaimer on YouTube, but most of them won't actually say it out loud, whatever. I want you to be aware of the fact that that is most of the times, and if not even all the times, that is the case. That's how these channels make money. Although I don't make buy or sell recommendations myself, because I think there is a clear conflict of interest. Many do. So you can sometimes, you can be watching something like that and someone tells you buy this stock, they might be paid by the company to tell you that. So please be aware of that fact. And anytime you're watching any type of company specific content, just approach it with a dose of skepticism. And dare I even suggest to you maybe even use your own brain for the duration of that content as you're watching it. Although again, I try to be different. And so unlike most, I try to do a decent amount of research, and I don't share the questions up front with the companies. No questions are off the table, and the companies get no say in what ends up in final video. That's kind of my 3 rules there. These things should still be looked at as advertisements and not as research, and least of all as recommendations. None of us know what we're doing. Otherwise, we wouldn't be making videos for a living. We'd be investing for a living. So the only thing that I can guarantee here is that there will be forward-looking statements in these general and impersonal conversations about future events that may or may not take place depending on many different things, both things that are within and outside of the company's control. So be aware of that, and please talk to a professional. Go to someone who's got a degree in investment advising, whatever that's called. And please do more research before taking any decisions by visiting setterplus.ca. That's a government official website that has all the company's official filings. So please go there, read them, and understand what you're doing with your money. There are disclaimers on your screen right now, but they're not only disclaimers, they are actually warnings. If you don't enjoy losing money, please pause the screen, read them, and be careful out there. With all that said, though, I'm going to be kicking off the barbecue now, and as it is warming up, I'll be traveling to Canada, Quebec to be specific, where I'll look at a gold exploration project and hear about it from Mark Fedosevich, the CEO of Vior Inc. The company is listed as VIO, so that'd be VIO on the TSXV in Canada, where an average of about 45,000 shares trade each day, with a 52-week high of 19.5 cents and a 52-week low of 11 cents. With a market cap of, call it $37 million and about 213 million shares outstanding. Today, this is an 18-cent stock. Adding 63 million warrants and 8 million options leaves us with about 284 million fully diluted shares, with management and board owning about 7% of the company. Cisco Mining owns about 14% of it, and Scotia 1832 owns almost 10%, 9.4% to be specific. And the Quebec institutional funds own about 12.5% of the company. Looking at the latest balance sheet, which is dated December 31, the company had about $3.2 million in current assets, $1.2 million of which in cash and CE, and $1.4 million in investments, and $500,000 worth of listed investments, part of which, by the way, is Ridgeline Minerals, another frequent guest here on Resource Talks. I'm actually talking to Chad soon, I believe, next week. And then there are, of course, stuff like tax credits on that balance sheet. There's account receivables, prepaid expenses for smaller amounts on here too. No major debts to talk about here outside of some account payables, lease liabilities, and then a small loan, but nothing major. And that same statement tells me that on average, Vior spends a little over $60,000 a month on administrative expenses. That'd be travel, marketing, management, so on and so forth. And then, or at least that was the average over the last reported 6 months, which is in line with the same period of last year. Whereas the average, there was an average of about $277,000 that was spent on acquisition and exploration of the company's mineral properties. And in terms of ratios, that would mean that administrative expenses represented less than 20% of the overall expense. As always, though, please understand that this is only a snapshot in time that I'm going over, in this case, specifically at the end of December of last year. And please head over to the company's website as well as setterplus.ca to look at all of the official numbers yourself and make sure you're getting the full picture there. More specifically, because after this financial report was published, the company closed 2 financings, specifically a $19.3 million one constituting mostly of flow-through shares. About 80% of this was of this almost $20 million financing was flow-through. It was done at 22.25 cents per share with a half warrant, whereas the hard dollars came in at 12 cents, 12.5 cents actually, also with a half warrant. And then after this financing, less than a month after it closed, the company did a second financing for $2.5 million at that same 12.5 cents with a 2-year half warrant. So in total, the company raised almost $22 million since the numbers I walked you through earlier. And there has also been a $1 million purchase of the former Belterre gold mine, which is located in the Abitibi, Temiskaming, or whatever way you're supposed to pronounce this region, the southwestern Quebec. And this is a large property, by the way. It's about 350 square kilometers of land. And so with the now over $20 million flow through and hard dollars combination in the bank, Vior is planning a rather aggressive drill program on the property with an expected 60,000 meters of drilling. This is not a new region, of course. People have been turning rocks in Quebec since before it was called Quebec, I suppose. But the lands were never consolidated. The lands that Vior is sitting on, they were never consolidated in the way that they are right now, which is what the company sees as an advantage to the stance of the company today, basically. Historically, gold has, of course, been the main focus here, mostly sulfide gold, sometimes in quartz veins with that historic mine, the Belter mine that I mentioned that the company just acquired, being the only one to actually produce gold out of those veins at an average grade of over 10 grams per ton, processing a total of 2.2 million metric tons. So that will be a bit less than 800,000 ounces of gold in total, pretty much all of which, not but 95% of which coming from one vein, creatively named vein number 12. There are multiple outcrops on the property too that Vior has been able to prove the continuity of at depth through some geophysical and geological and drilling work, limited drilling work, all of which has resulted in what the company now calls a drill-ready project, hence the 60,000 meter planned drill program. This is not the only project in the company's portfolio. They have quite a few others, actually, but those are under somewhat of a prospector generator model, if you will, where the idea is to use other companies' money to explore those projects, and Vior will then retain a partial ownership in them, as well as get cash or share payments as well as, of course, again, that work commitment on there. So I'm not going to go through all of these, of course, but if time allows for it, I'll ask Mark about them later on in the conversation. But before any of that, kicking it off with one of the statements that you make on the front page of your website, Mark, where you say that Vior is an exploration company that benefits from a history of exploration success for more than 35 years. Actually, I think it might be 40 now since the company was founded in 1984. And the chart goes back to the chart. The chart in the stock I could trace it back to 1996. But it also goes very steeply from sort of upper left to lower right corner, from about $6 back then to now under 20 cents. So that was around the time I was born. So if my parents had bought stock from me at birth and I remained a shareholder for 28 years now, I wouldn't have been able to participate in that exploration success that you mentioned on the front page. So a multitude of questions, I suppose, here. But why is that? What's happening? And what are you going to do to change it here?
Yeah, so, in answer to your question, Vior has been around since 1984, thereabouts. I came on about 6.5 years ago. I'm not privy to all of the prior ups and downs, market cycles, asset sales, and share distributions that have gone on. But I do know that over the years, there has been a reasonable amount of exploration success in various market cycles. Evidence of that is probably on a very long-term 30-plus year chart where you did have the opportunity to make some money in various cycles. I do know that just prior to my coming in late 2017, there was a large share distribution to Vior shareholders in an asset that they had on the books since I think around 2010. The asset is now owned by Maple Gold. So shareholders did have an opportunity to make a reasonable amount of money with that share distribution. It was also the launching pad of a reasonable treasury for the Vior that I came into. But my mandate really when I came on board was to find a flagship project, either generate one, merge into one. Not an easy task. There aren't a lot of great projects out there. But I think we finally stumbled across a really great flagship project that is now called the Belter Gold Project.
Right. And that's what we're going to be talking about here today as well. What you have going on right now, though, is you're working with sort of a double-edged business model, if you will, in a positive sense of double-edged. Then what I mean is that you have this, what I call during the overview of prospector generator model part of the business, as well as what I described before that with the Belter project, the flagship project, where it's an exploration story that you're going into aggressively, again, that we're going to be talking about later on. But is there a plan to to move away from that double-edged and sort of focus on one of those moving forward and divest from the other, or do a spin out or something like that?
Yeah, so at the moment, there's no real attempt to spin anything out. I find spin outs just are cumbersome. You have to create another company. There's added G&A costs and so on. I think what we've morphed into, and it's more by chance and our ability to turn a couple of our existing projects into flagship projects, real district scale projects, and find a good partner and advance these with other people's money. But the way we're structured right now is we do have our flagship Belter Gold project, which is really the focus of our capital expenditure, focus of our manpower as well. The other 7 projects we have, yes, it is more like a prospect generator model. As you can appreciate, we cannot be all things to all people as a junior explorer. So what I've endeavored to do, particularly over the past year, is to find good, well-heeled partners. Try to structure a deal whereby we receive cash payments, share payments, good expenditures on the project to advance them, while retaining a certain percentage interest in that project. So right now we have four of these 7 projects partnered, and they're all being advanced as we speak.
So you're going to be looking for new partners too throughout 2024, or is like 99% of the focus going to be on Belter?
Yeah, we do have 2 other gold projects, one in particular with a lot of potential. It's gonna take a partner with some pretty deep pockets to advance it. It's just the nature of that particular beast. I'm not actively seeking anybody right now, but I do believe we'll receive, assuming the bull market continues in earnest here, which I truly believe it will. At some point, I think we're gonna receive a lot of expressions of interest to partner with someone or to sell it outright.
Okay, what would your preference be? Partner or sell it outright?
My motto is always show me the money. If the numbers are right, I would certainly entertain an outright sale. But we'll evaluate when the time comes.
I like
But
that
clearly,
model.
our focus is to advance our 100% owned Belter Gold project at the moment. We believe that is the asset on our books near term that will provide the biggest potential value creator for our shareholders.
My wife is going to be editing this conversation later on. She's going to hear that show me the money approach, and she's going to be, oh, maybe I like that model too. And I'm not sure if I'm going to like that as much, but you have over 21 million Canadian dollars in cash right now. Is that still about what 80% of it is flow through that you have right now, or what is that split?
Yeah, so at the moment, I'd say our cash position is in the order of about $20 million. We just spent $1 million about a week ago to conclude an accelerated purchase of the old Belter mine. This is a deal we structured in early 2021 to purchase. We had a purchase option for 100% of the old Belter mine. I tried to back end it for the simple reason we didn't know whether we'd have success there, how the ground programs would go over the ensuing couple of years. So we tried to buy us some time before we had to expend some large cash and share payments. Now that we've raised a considerable amount of money, we had that optionality to conclude a deal to purchase 100%. The vendors were looking for cash, and I think it was a win-win situation what we just concluded. So it gives us certainty going forward here, assuming that we should have some good exploration and drilling success in the next 6 to 9 months. We wanted to ensure that we owned it 100%.
Okay. Yeah, sure. Well, yeah, that makes sense. Given how aggressively you're going into it, you had to buy it cash, sort of, well, hard dollars. You cannot pay for it with flow through, I don't assume. So what about over 90% of your money right now is flow through?
Yeah, so at the moment, I would guesstimate that we have about 14 million in flow through,
Okay.
uh, and the balance would be hard dollars. Um, and then, in addition to that, we have a special shareholder meeting on June the 7th, whereby we will vote, shareholders will vote to allow Cisco Mining to become a control shareholder. So their share ownership will go above 20%. Um, shareholders will also vote on allowing another Cisco member to come on our board. And they will also vote on allowing Osisco to purchase for an option to purchase a future royalty on the Belter project.
So they're going to go from 14 to 20. So they need
Yeah.
6% more of the company. Um, is there like you're probably going to do it in some sort of a VWAP calculation, or like
No,
what's the
it
pricing going
was
to be?
it was part of the original brokered financing. So there was a component that was issued via sub receipts. It's the way we had to structure it to get it done. We knew that as soon as Osisco went over 20%, it would require a shareholder vote. So we structured it as sub receipts. So there's just shy of $2.5 million sitting in the form of subscription receipts to be voted on in a few weeks. So there'll be a further, assuming the vote is positive, which I wholeheartedly believe it will, there'll be an extra 2.48 million hard dollars coming into Vior Treasury, and potentially another $250,000 as a payment for the option to purchase over the next 5 years of future royalty on the Belter project.
So 8 to 9 million bucks hard dollars is what you're going to
Yeah,
have.
I would say our hard dollar position should be situated somewhere in the order, let's see, to be safe, $7 million or
Okay.
thereabouts.
Yeah. Clearly, hopefully enough to cover G&A. I think we're going to have a difficult conversation if that's not enough to cover G&A. But well, what do you think? I mean, G&A was relatively low over the last 6 months, about 60 a month, if I had that correctly. Um, do you think it's going to stay there? What are you planning for G&A?
No, G&A will definitely go up. So I think our G&A was probably closer to 70,000 a month or thereabouts. So call it 850 just to be safe. Um, I do plan on turning on the marketing, market awareness, IR tap to really get the VR story out to the world.
Hmm.
I view this as a global story, not just a Canadian-centric North American story. There's investors worldwide, I think, that we can attract in our stock. So there will be an additional several $100,000 budget allocated towards that. We're finally ready to get the story out.
Right. Okay. So G&A, how much do you think is going to double, or how high do you think?
I would say just to be safe, somewhere in the order of $1.3 million for the coming year.
Okay. Right. Okay. So a little bit more than 100 grand a month.
That is correct. Yes.
Yeah. Okay. Fine. 60,000 meters. How much you think they're gonna be paying per meter? Have you already spoken to drill contractors? What kind of quotes are they giving you?
Yeah, so we'll probably finalize our drilling contract sometime towards the end of next week. We had 10 different companies submit. We're down to 4 right now. There's a number of variables we're going to be looking at to make our final decision. We estimate that all in drilling should come in somewhere around $175, $180 per meter, all in Canadian assays and all.
That's not a lot of money. Is it cheap because it's well, it's a lot of money in the grand scheme of things because that's 11 million bucks or something like that for the 60,000 meters. But it's I mean on a per meter basis, it sounds like it's cheap. Is it because it's Quebec? Is it because it's a big drill program? Why is it that price?
Sure. There are a number of factors. I mean, we're really situated near the mining hub of Quebec. You know, our project is located about 95 kilometers south of Rouyn-Noranda and Val-d'Or. We have access to all the manpower and infrastructure available in the Abitibi in Quebec. We are located in a old mining town, or we have an office in an old mining town, lodging for 15 people as well. It's really a dream location for a lot of drillers. So costs are commensurately a lot lower than a lot of other locales. So we're blessed with that, and we're also blessed with the fact that we can drill literally 12 months a year. So the drill program that we envisage will be a 24/7 operation. And we're gonna, we can get into number of drills, targets, and so on a little later. But really, it's location, 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 and that's what affords us a very favorable drilling cost.
I do want to get into all these things and a little bit of the geology here later on too. But I'm also thinking why. I mean, typically exploration stories get to 60,000 meters of drilling over multiple years, multiple drill programs, multiple financings, and so on and so forth. And you kind of do it all at once. Like you go from relatively limited surface work to a rather large investment in a short period of time. How come? What's the risk reward that you looked at when taking this decision?
Sure. Yeah, I'd say we did a lot more than limited surface work. So, just to give you a lay of the land here, we've literally spent 3 years doing all the heavy lifting. So that would include, well, originally consolidation of the project, digitalizing all the old mine data that we procured, 4 different field programs over that 3-year period. Working with structural geologists, total reinterpretation, a new 3D structural model, and a large stripping program last year. So there's a lot of heavy lifting that's gone on behind the scenes to get to where we are. The decision to look at a significant and extensive drill program of 60,000 meters was basically on the coattails. We had no shortage of targets. Our confidence level improved dramatically over the past couple of years with the added field programs and the stripping program that we concluded last fall. Osisko Mining came on the property last November. They came to the same conclusion as we did. We're ready for a significant drill program. What was lacking was the capital to undertake such a program. As you can appreciate, a lot of juniors our size. I mean, we were 14 million market cap 7 weeks ago, with a couple $1 million in the bank. Most of the time, companies of our stature look to undertake the 5,000 or 6,000 meter drill program to test out the highest priority targets. It can be a recipe for a lot of success, but it can also be a recipe for disaster. And if you don't hit, you got to go back to the market, explain why you didn't hit, and that vicious circle just continues. Go find the next batch of money to drill another 5,000 or 6,000 meters. So by undertaking a really extensive drill program like we're proposing, and we had no shortage of targets to get to that 60,000 meter level, we have a very high confidence level that we should deliver a good amount of success to our shareholders.
Well, I mean, it's a big statement. You're putting your money, show me the money, right? It goes back to what you said earlier. You're putting your money where your mouth is. And you're also going to have some money left after this. As it's 60,000 meters, about $11 million in flow through. You're still going to have like $3 million of flow through left. And then you have next year to spend it too, right? Because you raised it in 2024. So you have by the end of 2025 to spend it. But that money that you're going to be spending here, what is the focus going to be mostly on greenfield discoveries, or are you going deeper on the old mine? What are you thinking?
Yeah, so at the beginning, I'd say 25,000 meters, which are really our highest priority targets. They're going to be around the old Belterre mine and the mine trend where there's some known deposits. So given our new lithostructural model, we've got a pretty high degree of confidence. A lot of the first drill holes will be 100-meter spacings. It's more delineation drilling than exploration drilling outright. We could, conceivably at that spacing, come up with a resource. That's not our objective in any way, shape, or form in the near term. But if the program is structured in such a way it's adaptable. So should we have some really good success around the old Belter mine in the very early going, we could quickly ramp up and submit for additional drilling in that area in 25 to 50 meter spacing.
When do you want to have a resource out?
It's not in the immediate term. Let's take it one day at a time. I mean, we plan on drilling 60,000 meters here to begin. It's just the beginning. This is truly a mining camp where the potentiality is for multiple deposits on this project. So I wouldn't want to cap a resource too early. Let's test out sort of the low-hanging fruit with this first 60,000 meters. And, should we have some really good success in the early going and we ramp up to additional meters, let's one day at a time, but not in the foreseeable future.
That's what I was thinking mostly about, not necessarily in terms of a timeline. Like I don't want a specific month. What I'm thinking about is how much drilling do you think you want to put in this before you come out with an MRE? Like is 60 enough? Or do you think you're going to have to put like 120? How much do you typically have to? I mean, based on your geological thesis, how much would be enough?
Yeah, I mean, I wouldn't want to put a hard number on that, but I would say somewhere in the order of several 100,000 meters.
Say that again.
I would put it in somewhere in the order of several 100,000 meters.
Okay, right. Okay. I thought you said 700,000 meters, and
No,
I was about to hang up.
100,000.
That's good. I was about to hang up, but no, jokes aside, maybe you can, I mentioned that geological thesis. Maybe it'd be easier if you can sort of walk me through the geological thesis, not sort of in the brownfield, but or maybe in the brownfield too. But what I'm interested in is also the greenfield and sort of why you believe there could be more gold outside of the historic workings, and what your geological thesis is on specifically on what's controlling that potential mineralization there.
Yeah, so the real focus initially is going to be on the brownfield area because it's 12-kilometer long system, and within that 12-kilometer long system, there's also what we call the Belter mine trend, which is 6 to 7 kilometers long, which will be the focus of roughly 80% of those 60,000 meters that we're going to drill. But outside of the brownfield, which is a huge playground, we've identified several other areas where we're going to have a couple field crews on the ground this summer as well. Could they be drill ready in a short period of time? Yes. There's overburden. There's an analog area in one instance to the northeast. Very similar geochemical, geophysical structures as the Belter mine trend. And to the north, there's more of an intrusive type ore body that we will be looking for. But it's much too early to go any further into this. It's going to require some more field work before we get there. We're going to have our hands full in the old mine trend and the brownfield for the foreseeable future.
Oh, okay. So how's that going to go chronologically? I mean, you said you can drill year round, but the first part of the program and over half of the program basically is going to go into the brownfield. How's that going to work chronologically? When do you start? When's that done?
Sure. So we're in the permitting process as we speak, well into it. We're hoping to have our permit enhanced sometime next month, mid-June. And assuming we do, that we will likely begin drilling roughly a week later or thereabouts. So the game plan is to start with 2 drill rigs, possibly ramp up to 3 in a few months later. We're going to learn to walk before we run here. This is new to us as well. We're not Osisko Mining, who, with potentially 20 rigs or thereabouts. But we could quickly ramp up, assuming the initial drilling goes very well.
Okay.
So the game plan would be to drill those 60,000 meters by the end of next March or thereabouts.
Oh, okay. But okay, interesting. Because but there's not going to be any interruption in between. Then you're just going to keep drilling. How many drills are going to be on site?
So 2 drills to begin with. It's going to focus into the Belterre mine trend area where the old mine is, and where we have other known deposits called Conway, Paquin, and Obel.
Right. Okay.
Those are really the highest priority drill targets that we have at the moment.
How do you think about announcing assay results? Like, how are you going to do it all at once? Batch it? Yeah.
Yeah. Uh, right now, we're sort of thinking in batches of 8 to 10 holes. So we would expect probably initial results, depending on turnaround time, with the labs up in Val d'Or, sometime during the month of August. I'd say second half of August, just to be safe.
Oh, okay. And then after that, how long is it going to take you? So 2 rigs. How many meters are you going to be doing a shift?
Well, that's the big unknown. We'll see. We'll see what kind of output we get out of the shifts, but we're sort of targeting 100 meters per rig a day.
Okay, 100 meters per rig a day.
But it could be more, or it could be a little bit less.
What I'm trying to figure out is how often are you going to have news release, basically?
Oh, it should be pretty continuous. Like, I mean, assuming we do it in batches of 8 to 10 holes, um, the first results sometime second half of August, just to be safe. With 2 drill rigs turning, it should be continuous every sort of month and a half or thereabouts.
Okay, every month. Yeah, that
Month and a
makes
half
sense.
to 2 months, thereabouts. It'll
Right.
depend on turnaround time. Obviously, if we saw a lot of visual gold in some of the core, we have the ability to do rush assays. But I don't want to go there at the moment.
Right. Okay. What maybe we can talk about again, as I said, you actually don't sound as interested in the greenfield potential here, are you? I mean, what do you think about the greenfield
Yeah,
potential?
interested, absolutely interested for the long term. But in the short term, we have our hands full in the brownfield area, and we think we can delineate a lot of ounces there to begin with. So why not go for the low-hanging fruit? Even though the other greenfield areas are very promising as well, we're going to continue to advance them on the ground this summer and fall, but it wouldn't be the focus of any of our drilling meters for the coming year, for sure.
Okay. What's logically, if we look at the land package on the greenfield, how similar is that to what you have at the old mine?
Yes, some of it is very similar. It's never been explored. I mean, we've done some till sampling. We had a couple field crews up there last summer. There is what we call the 3 analog areas. The only difference with the mine trend is there's somewhat of a fair amount of overburden, anywhere from 5 to 15 meters in many locations. So it's a lot more difficult to do field work up there. We're going to look at a number of ways we can maybe tackle that via some geochemical and some geophysical type surveys.
Okay.
But it's really early going there, Antonio.
Right. Right. Yeah. Well, I suppose I like sort of going from 0 to 1. That's where I'm coming from. My interest on this, on the brownfield stuff that you're going to be drilling. Is that primary gold mineralization, or did it get there in a different way?
It's primarily gold mineralization. I mean, if you look at the old Belterre gold mine,
No, I mean, is it primary mineralization, as in terms of how it got mineralized and what you know about it right now? 'Cause I understand it's mostly gold, but I'm thinking, is it primary or secondary gold mineralization?
no, it's primary gold mineralization
Okay.
in all respects. There's a few advanced targets in the brownfield area. They won't be drilled immediately. They'll be probably, I'd say, 6 to 8 months out, with a very high silver component as well, which is kind of interesting. But in addition to the Belterre mine trend, which is really an orogenic type deposit, shear vein hosted. There is potential in the brownfield areas for some VMS and intrusive type deposits as well. So, which is very interesting, and we will be testing these advanced targets as well.
Well, that's interesting because I saw that in your presentation too. You mentioned the potential for dike and sill related gold-bearing sulfides, as well as a banded iron formation mineralization, or a vein-hosted, as you said, deposit. So having this wide-ranging potential, I suppose, can be a blessing and a curse in that it's maybe not as straightforward to pick drill targets. But then you said you didn't have a shortage of drill targets. So how do you do it? How do you pick drill targets? How do you prioritize drill targets?
Yeah, so our team has spent months at this, looking at the highest conviction targets, which are really situated in the areas where we have the highest degree of data. And that would be in the old Belter mine trend area. So that would be that 6 to 7 kilometer long trend. And I'd say the lion's share of the drilling will occur there. Roughly, if I were to put a guesstimate, about 50,000 meters of the overall 60,000 meters.
Okay. But you also done geophysics, as you mentioned. What's that telling you? What's the geophysical footprint here telling you?
Yeah, it's pretty straightforward. Our new reinterpretation, new lithostructural model, what we've learned, particularly from including a stripping program that we undertook late last fall, is there is going to be a stacking of veins, okay, which was not widely recognized before, and within these vein structures, there are these flattening or fold hinge areas, and we've seen that in the old mine workings and the old mine papers, where you typically get areas where you get these fold hinges and flattening of the veins, where we encountered in the old mine areas of 10 to 20 meters of 10 to 20 grams per ton. So these are the shoots and the targets that we're going to be focusing on. And we believe that we could hit multiple veins the way we're going to be drilling the system in one hole.
Yeah, I believe you mentioned somewhere as well that those are telluride and alkaline, or potential for telluride and alkaline vein types. Is that am I getting it correctly? And if that's the case, are you going to be doing metallurgical work this year too to figure that out?
Yeah, well, if you look at the old Belter mine, it was a really clean ore. Recoveries are well in excess of 90%. I don't have the exact number available, but there was no arsenic in the gold. So we're very fortunate in that regard. Like some of the older past producing mines, they had a lot of refractory ore body in them, a lot more difficult to recover. And a lot more complicated, but everything we've seen thus far, and with the old Belter mine, is the metallurgy is very clean.
That's exactly where I was coming from. I'm not hard to figure out, I suppose, but that's what I was thinking about refractory gold. I think I made a joke once, but I said life's too short to deal with companies that do refractory gold. Only half jokingly, but yeah. What's the alteration that telluride and alkaline are associated with, or yeah, let's start there.
Yeah, I don't have I'm not a geo or mining engineer by training, but
Okay.
I'm not quite sure where you're driving on that question. Are you talking with respect to the metallurgy, or?
No, I was thinking about what the alteration package is on them and how that alteration package, as well as the halos that you might have observed, how you're going to employ that into the drill targeting.
Yeah, well, what we've seen, we're going back using all the data available to us from the old mine. What we've seen are these stacking of veins, as I mentioned to you. This is shear hosted vein systems. We've also seen these fold hinges or flattening of the veins in certain areas where we see veins turning, sort of like an S curve, and that's where we see the big concentration of gold. And those are going to be the real focus of our targeting with our drill program, where we believe we can hit some very wide veins systems with really good grade of anywhere from 10 to 20 grams per ton. Historically, the old mine, followed one vein. It ranged in total for anywhere from 1 to 4 meters, typically in size. But where you had those so-called fold hinges and flattening of veins, that's where you saw a significant concentration of gold. So if we can see this on a continuous basis with good concentrations, that's where you can build some ounces very quickly.
Right. You don't have to go deep for that, though, right?
No. So just to give you an example, an idea of our drill program. So at the moment, we have 123 holes planned. They're going to range in length from 150 to 850 meters.
Okay.
The maximum vertical meters will be about 750 meters, and the average hole will be about 550 meters. The game plan here is the bulk of the ore produced at the old Belterre gold mine was between 0 and 250 meters. Of the roughly 800,000 produced, well in excess of 700 was produced 0 to 250 meters. This mine was in production between the late 30s and late 1950s. Back then, they didn't drill deep. At the end of the mine life, they did follow a shear vein system that extended down to about 550 to 600 meters, roughly. And the only reason they did that was for economic reasons. They had already sunk a deep shaft, and it was a lot cheaper just to follow this vein structure on a vertical basis, as opposed to the north, where we think it's plunging. It's a little bit different now. We believe that we have the potential to replicate those amount of ounces of gold around the old Belterre mine per 250 vertical meters. So that is our target. That's why we're not going to be drilling below 750 meters on this first program. We believe we can build a good amount of ounces between, let's say, 150 meters down to about 600 meters.
So the farther you go, the farther away you go from the mine, the shallower the holes are going to get. So around the mine, you're going to start doing the deeper, so 750, or like, how's that going to work?
Yeah, around the mine, we're going to start at 150 meters, actually.
Okay.
We believe that there's these stacking of veins that occur near surface. We're going to test out some of the old stopes as well. We believe there's gold still at the old mine. How much, that really isn't the objective of our exercise. What our objective is to find the next several million ounces of gold there. But we will do some drilling just below the old mine, as shallow as 150 meters. We believe there's still gold remaining.
All the production, pretty much all the production, 95%, as I mentioned at the beginning, about 800,000 ounces came from vein number 12. Curious name. I mean, it makes you think there's 11 other ones. Is that the case? Like, well, why is this vein 12?
Yeah, I mean, back then it was old school mining. You found a very rich vein, you typically followed it. That's not the way we mine today. I think the way they drilled in the past is not the way we're going to be drilling today either. If you look at our structural model and our belief that there's stacking of veins, just below the old Belterre gold mine. In the past, they drilled from south to north. A lot of times, they probably would have undercut some of these rich veins. We're going to be drilling almost uniquely from north to south, hopefully hitting multiple veins within an existing hole. So very different, but we think there's a lot of ounces remaining. You're probably very familiar with the Abitibi. Some of these shear-hosted gold mines go below 3,000 meters. So there's significant potential to replicate ounces, even in the first 750 to 1,000 meters from surface.
Right. But so based on historic data, you're not aware of the previous 11 veins that might have come before this vein number 12.
No, we do know that mineralization does extend at depth. We proved that concept. Well, one thing we did little over 2 years ago, we did a small drill program, mostly around the Conway, Obel, and Pauquin deposits. We proved that mineralization did extend 500 meters below known mineralization. Nobody ever drilled that deep. So nothing is truncating. People often ask, well, how do you know there's gold below the old mine or below some of the other known deposits? Well, we've tested, nothing's truncating any system below surface that we know of. I can't say that's not possible at 1,500 meters or at 3,000 meters, but for the foreseeable future, we know there's mineralization potential below what is already known.
Okay, good. Well, it seems like it's relatively straightforward now from the perspective of you have the money, you have the plan, you just go and drill it and turn on the truth machine basically right now and see what happens. What am I missing? Like, what's the catch? It sounds simple. Mining is not supposed to be simple. Exploration even less so.
Nothing is for sure. Let's be realistic. This is a high risk business. What we've tried to do is reduce that risk as best we can, i.e. de-risk by doing all the heavy lifting on surface, doing a small preliminary drill program to prove that mineralization does extend at depth. The proof is going to be in the pudding, obviously. But we know there's still ounces there. Back in the old days, in some of the stopes, there's probably 4 to 6 gram material that they wouldn't have mined. They would have followed the shear-hosted high-grade chutes where they were looking, back in the 30s to late 50s for 1 to 2 ounce material at the time. So very different. We're looking to build ounces with hopefully a continuous ore body, as continuous as can be, but it's still high risk. Let's be realistic. Exploration is high risk, but we've done a lot of heavy lifting to de-risk as best we can, and we're at that stage. Let's go attack this thing and show the market that there's still a lot of ounces there and a new discovery.
Oh, well, thank you, Mark. I appreciate you saying that. Exploration is indeed a lot of risk, and I'm glad you're not hiding away from that or trying to hide that. Hopefully you keep coming back to the grill to update me on what's happening with Vior in the meantime. And I do wish you good luck in finding those additional ounces. You have an aggressive program, so it'll be interesting to see where that goes. I'll for the time being though, I'll let you drop off as I'll be flying to someplace with a better weather. I'll be flying to multiple jurisdictions at the same time. With that being Arizona and Mexico, to hear about Prismo metals from Steve Robertson, the company's newly appointed president. Company is listed as Priz, so that'd be PRIZ on the CSE in Canada, where an average of about 50,000 shares trade each day with a 52-week high of 34 cents and a 52-week low of 13 cents. With a market cap of about $8 million and about 40 million shares outstanding, today this is a 20-cent stock. There are 700,000 founders warrants at 10 cents and almost 5 million warrants at 75 cents, on top of another 5 million insider options and RSUs, resulting in a total of about 51 million fully diluted shares. Management is a large shareholder here at almost 30% ownership of the company, and Vizsla Silver is a large strategic shareholder. That's going to make sense in a second why, and they hold a hair under 10% of the company as it is right now. Looking at the latest balance sheet, which is dated December 31, the company had about $1.5 million in current assets, most of which, so $1.3 million of which, to be specific, was in marketable securities, and that is in the form of 750,000 shares of Vizsla Silver, which, by the way, valued at today's market price, those shares will be worth about $1.7 million. there was some debt at the time of the construction of that balance sheet of about $1.4 million, mostly in the form of account payables, part of which, by the way, has since been settled by the company through the issuance of almost 3 million common shares at 17 cents per share, and a large part of which was issued to a mining service company based in Mexico that is owned by the company's previous CEO. And that is partly because Prismo operates on the basis of not wanting to have too much of an overhead. So basically trying to lower their fixed expenses. So they typically work with service contracts, including the management team, as far as I understand it. So that's where that expense is coming from, as far as I could track back. Now, that same financial statement also tells me that on average, Prismo spent about $90,000 a month on administrative expenses, basically, which is about in line with the same period of last year. And I'm also not including the in total $1 million of share-based payments, by the way. So that's $90,000 only the cash expense here, whereas an average of about $315,000 was spent on exploration and evaluation of the company's 3 properties in total. And to put it simply, this means that, again, excluding share-based payments, and I'm rounding up, the company spent about $5 million over the last fiscal year, less than 25% of which on what I would call bureaucracy, but it's administrative expenses. And so 75% was spent on the rocks, if you will. As always, please do understand that this is only a snapshot in time. That's really what this is. In this case, specifically at the end of December of last year. So do head over to the company's website as well as setterplus.ca to look at all the numbers yourself, make sure you're getting the full picture, and make sure you're up to date with everything. Again, high-level asset overview here says that there are 3 projects in Prismo's portfolio in total, that being the Hot Brecha copper project in Arizona, some land holding in the Panuco district of Mexico, where the focus is silver. This is surrounded by, and also explains the relationship with Vizsla Silver. And then there's another land holding in the Sonoran district of Mexico. It's called Los Pavidos, which is, this is a shear-hosted orogenic gold target. I'm not going to go over the latter 2 projects, so the Mexican projects. I'm not going to talk about them in depth, but I will be asking about them later on. And why I'm not going over them in depth is because the focus for the next couple of years for the company will be the copper project, Hot Brecha, it's called. Hot Brecha, by the way, is currently under an option agreement from Infinitum Copper, and Prismo can acquire a 75% interest in it over time through, well, earning it in, but also some payments. They've already made a $350,000 payment toward it, as well as issued 500,000 shares to Infinitum. And then there's the work commitments that are probably on your screen right now, but it's $500,000 this year in work commitments, $1 million next year in 2025, $1.7 million in 2026, and $2 million in 2027. And that will be a total of $5,250,000 of work commitment to get to that 75% of ownership. And that is on top of additional, as I said, cash payments on top of the $350 that was already made. There is another $540,000 of property payments to be made over this and the next 2 years after this one. Again, Hot Brecha, this is in Arizona. It's in the southern part of the Arizona copper belt, and it's about 4 kilometers away from the historic Christmas mine, which is a historically producing mine and produced 480 million pounds of copper at an average grade of 1.2% Cu, with some gold and some silver credits in there too, although not too massive. Lithologically, what the production came out of and what Prismo has claims on look rather similar, minus about minus something, call it a cover that consists of volcanic rocks. And I'll talk to Steve about that later on. But so those are Williamson Canyon volcanic rocks for the most part, as well as some limestone. That's NACO limestone specifically, after which, again, a couple of 100 meters below that, below where the Christmas mine, so Escarbrosa limestone starting to pick up, is where Prismo thinks they have kind of the same thing, I suppose. As the name might have given it away, though, the company has found proof that there is a hydrothermal system that's cooking at depth here. That's explaining the hot part of the name of Hot Brecha. And then the latter part, so the Brecha part of that name, is explained by the, well, you guessed it. You might have never guessed it, actually, but it's by a Brecha. There's actually multiple Brechas that can be observed on top of that volcanic layer that I just told you about, with the thesis being that a chemical reaction was happening at depth. It created somewhat of an explosion, an underground explosion, if you will, that brought up that Brecha, shot up that Brecha really right up to surface. Quite cool if you think about it, or at least if you're like me and don't often leave your apartment, then it is quite exciting to think about it. So Naturally, yes, Prismo sampled those breccias, found rather high grades of copper in those surface samples, suggesting that the hydrothermal theory that I was telling you about earlier might be true at depth here. But Prismo is actually not the only company to have had that thesis and tested it. Over half a century ago, Kennecott poked some deep holes into it. So yes, it is historic data, so be aware of that. But that drilling showed hydrothermal alteration both within the volcanic rocks that are closer to the surface, as well as growing intensity of that alteration system at depth, which actually might be a good starting point and a good point for me to start shutting up for the discussion here today. Because Steve, if Kennecott, and I believe Phelps Dodge too, when they drilled those holes, if they like what they were seeing and their exploration thesis got confirmed by finding that alteration in there, why they stop, and why did this project not go anywhere for the 50 years after that?
Yeah, well, thanks very much for having me here today, Antonio. I appreciate it. Yeah, the exploration that the guys were carrying out, and keep in mind that this happened back in the 1970s. So the holes that they were drilling were not for the faint of heart. These were very, very deep holes for that era in particular. So they really had a great conviction to the exploration model, but the Christmas mine shut down in 1982. Once the major center for processing ore in the area shut down, then the priority for that project became lower. They got distracted, went on to other projects, and it was actually didn't happen overnight that they went from on to off. They kept the property expecting that they were going to go back to it, and then eventually the property got dropped just because they had priorities elsewhere. And there was no operating mine right next door to it anymore. So they got distracted, and then eventually they actually threw the core out because the Kennecott did, because they needed room in their warehouse. So, you know, it really was a long 2 decades of deprioritization to get to the point where they actually dropped the property. And then the current owner was able to go in and pick it up. His name is Linus Keating, a geologist out of Tucson. And we eventually were able to make the option agreement with him.
Is there still does he hold the royalty on this project, or is there someone else?
Yeah, it's actually a private company that's controlled by Linus and 2 of his partners, and they'll have the residual 2% NSR on the property.
Okay, and that's the only royalty. There's no one within management that has a royalty on this project.
That's correct. Yeah.
Okay, good. Yeah, that's just kind of sort of a smell test, if you will, that I like starting off with. What's the reason behind the different stratigraphy between what you have, what the Christmas mine had, as in this cover? Like, why is it there in the first place?
Yeah, well, you know, it's really an interesting thing. I think you can make this comment about industry in general, but the stuff that was over at Christmas was sticking out on surface. So those limestones that were hosting the ore could be walked over and sampled and prospected. And over on our property, we've got the thick Williamson Canyon volcanics, and we think that they're up to 400 meters thick. And so that really provides a good treasure hunt for us. And I think that's why, when you take a look at the industry in general, the discovery rate over the last 15 years has gone down to 0. There's been no major discoveries being made. And I think the easy stuff sticking out on surface has largely been found, certainly in the more mature districts. And the next generation of discoveries are going to be plays like Hot Breccia, where we actually have to do a little bit of investigative work by drilling down over the cover rock, through the cover rocks, to get into the more interesting rocks down below.
Yeah, but so what's the history? I mean, how did they? What sort of the geological processes that put those rocks where they are right now?
Well, it's really interesting. You know, I draw the analog with the Resolution deposit that's 40 kilometers to the north of us, one of the greatest exploration discovery stories in our modern industry. And they actually looked 1.2 kilometers down to find the top of the Resolution deposit. The bottom is 2 kilometers down. But they found it by tracing down the mineralization from a nearby mine called Magma, where they mined about 20 million tons of 5% copper, and then went to look for the roots of the system. And that's what eventually led them to find this giant deposit. Well, we've got a very similar situation where we've got the Christmas mine next door. And we've got the thesis that if we follow that down to find the roots, hopefully we'll run into bigger, higher grade mineralization, much like they did with Resolution. And the structural setting at Resolution is a graben. So they've got normal faults where part of the geology was dropped down, and then the intrusive rocks come in and exploit some of those faults. That's the way they get into the system and create all of this hydrothermal chaos that results in the high grade ore. And we've got exactly that situation. We've got a graben environment with normal faults, and the geology on the Hot Breccia property has actually been dropped down, much like it is at Resolution. And we've got the faults that have been exploited by, in our case, the Christmas stock. And that was the intrusive body that brought in all those hot, acidic hydrothermal fluids that were carrying all the metals. And when those fluids interacted with the surrounding geology, in particular the carbonates, and I'll just divert a little bit to, talking about that interaction. The experiment we all did in junior high school when we made the paper mache volcano and put some vinegar on the baking soda and it effervesced. That's exactly the chemical reaction that happens between those hot acidic hydrothermal fluids and the carbonate rocks. And it neutralizes the fluid and causes the high grade mineralization to develop. So it's a really fascinating process, but that's the main reason why we get such high grades in these types of systems.
So the carbonate rocks are the sodium bicarbonate, which is the stuff we put in the volcano, and then the hot fluids are the vinegar, only they're hot. And so, okay.
Yeah.
Cool.
Calcium, it's not sodium bicarbonate, it's calcium carbonate in this case,
okay,
because we get but you're right. Yeah, that's the reaction that happens, and you get carbon dioxide that's driven off. And that's another one of the reasons why we have those breccias, is because that reaction, we believe, caused the pressure that needed to be released. And then all the rocks get broken up in this violent release where the rocks get actually carried up to surface. And we've mapped those breccias. We've actually found that some of the rocks that are in the breccia come from at least 1 kilometer depth. So that speaks to the amount of energy that was in the system.
And why I'm asking you this sort of is that about the history of how it all got there is because I'm leading up to your geophysics. So I believe you did a Z-TEM is what you did. That shows a resistivity low. So basically meaning that there are conductive rocks down there, down below all of this. And I'm kind of trying to figure out how it might have gotten there. But it's also about the depth of where the NACO limestone should be, which is not typically conductive rock, right? Unless it's got metal in it. And so you see that as well, you basically see that as all the more reason to go and investigate, understandably. So, but what I'm thinking about is, so first of all, how could it have gotten there? And secondly, and more importantly, maybe what could it be? I mean, is this necessarily copper making it as conductive, or could this also be a graphitic material or sort of, I don't know, pyrite or something else that's throwing off that survey?
Yeah, so the whole premise behind geophysical surveys in our business is that we look for things that are unexpected. Anomalies, we call them, because when you are looking down into the earth at the electromagnetic signature, you should be able to predict what it's going to look like. And when you get a reading that shows you something different than what it should look like, you scratch your head and say, well, why is that? And in our case, we've got this resistivity low or a conductivity high, where we're seeing a conductor buried down in the area where there should be limestone, as you say, non-conductive rock, and for some reason it seems to be conductive. And one of the good explanations for that would be that it's mineralized with copper, but there are other explanations as well. It could be, in many cases, depending on the environment you're in, you could have graphitic rocks, you could have a pyrite halo from a hydrothermal system, it could have a barren hydrothermal system that doesn't have any copper or any other interesting metals in it, and it's just got iron sulfide. That could be a conductor as well. So the only way to really tell is to do the truth test by diamond drilling and getting down and actually seeing the rocks that are down there.
Forgive me if I sound uneducated on this, because I actually am. I'm obviously not a geologist, but does the intensity of the res low, is that something you can read into as well, where you say something like, okay, yeah, it's conductive, but it's maybe actually like too conductive for this to have a percent copper. It's behaving more, it's as conductive as if it's got like 40% pyrite. Could that be the case?
Yeah, we might be able to start to calibrate our observations once we actually get a diamond drill down there and we get more information about the rocks. But at first blush, we're starting off from a standing start, I think you would describe it as right now. And so until we get more information on the rocks that we're looking through, not only the rocks themselves that are down at the target level, but the ones that are up above it, which also affect the signal. We're really not going to be able to calibrate our response until we see more information from down deeper.
Okay, so it's not like you can look at the survey and say like this is too conductive, therefore it's like a lot of metal. Like there's no different levels of conductivity.
No, there's nothing that you can actually just apply a template to every property in the world. It's really, there's so many variables, a vast number of variables that result in the readings that you're getting at surface. You need to get down into the rocks before you can calibrate your response.
Right. Okay. How special is this blob, if you will? Like, is this an occurrence that happens often in ZTEMs, and how often does it result in sort of the successful targeting of discovery holes?
Well, yeah, I don't know the statistics on that. I know that geophysics, it's kind of like my golf game. You get a really good drive in every once in a while and it keeps inspiring you to come back for more. And geophysics is kind of like that for me. I've had some great successes with geophysics in the past. And, I've seen responses, a great deposit that I worked on was Red Chris, and the geophysical response from that was just wonderful. And, that inspires me to go out and use these geophysical tools every time I get the opportunity. And yeah, sometimes you do get disappointed in what you find, and sometimes it allows you to refine the way you're processing the data so that you can actually come up with a slightly changed interpretation. Maybe you're off the mark a little bit, and sometimes it's just there's nothing there. But there's no way to tell until you actually use the drill to test the thesis. Now, what you can do is stack the odds in your favor by going into favorable environments like we're in here in the heart of one of the most prolific copper belts on the planet, with one of the greatest discoveries in our business 40 kilometers to the north, and one of the North America's first block cave 35 kilometers to the south, one of the biggest copper deposits in the world 100 kilometers to the east. These are all factors that are stacking the odds in our favor.
Right. That's something I do want to touch upon. Block caves are obviously an interesting thesis that you can start with, but maybe later on, basically, again, as you said, turn on the truth machine is what you have to do right now. Turn on the drills. So what are you thinking? Go and drill a few, like a couple, how deep of holes are we talking about? Are those the 11, 12, 1500 meter holes or less?
Yeah, what we want to do, we don't want to go to a prescribed depth. What we'd like to do is go all the way through that carbonate stratigraphy. So we've got these Paleozoic carbonate rocks that we think are going to be the attractive host for this style of mineralization. And we want to drill until we get down into the basement rocks that we know are going to be down below that. And they're pretty easy to identify. They're wonderful quartzite sandstones. And so very different from the carbonates. They might be at 900 meters depth. They might be at 1300 meters depth. So we'll drill the holes until we get all the way through the prospective stratigraphy. We're expecting them to be about 1,000 meters deep each. And so we think that if we go in and do the initial round of drilling, should be about 5 holes, 1,000 meters deep. And we'll see how far that gets us. Hopefully that taps us into the system, or at least it gives us a good idea of what way to look to get into the heart of the hydrothermal system.
And that's deeper than what was drilled there previously, historically, right?
The previous drill holes, some of them were pretty deep. I think the deepest one was about 3,300 feet, which would be almost a kilometer, but not exactly in the right location from, based on the geophysical results that we've gotten.
Okay. So you don't have to, well, you're not going to be twinning any holes then this year.
Oh, we do expect to twin at least one drill hole, but we haven't definitively set the agenda for the drilling yet, because we've undertaken a process where we're going to use an AI company to reprocess our geophysical results. And the idea there is these are deep, expensive drill holes. They take about a month each to drill. And so we want to make sure that we maximize our opportunity to fully test this geophysical anomaly. And so we're going to wait until we get the results from the AI process, and then we'll choose our actual drill holes. But there's a very good chance that at least one of those drill holes will twin one of the old holes. Keep in mind, with the old drilling, we do have the drill logs. We've never been able to see the drill core because it's been thrown away, and we've never gotten the full assay results from the lower parts of those drill holes. So we've been able to get some information about the grades that were intercepted from old memos and reports and so on, but we don't actually have those actual assays from the old drill holes. So twinning an old hole will be a good exercise for us.
Okay, but then you just said that they were not in the right location, those historic drill holes.
Yeah.
So why twin them?
One of the issues with the old drilling, we think, is that they didn't go deep enough. They didn't get all the way through the carbonate stratigraphy. And so we feel that there might be an opportunity to actually glean information, not only from twinning the old holes, but also extending them and going deeper. Okay.
What about the presence of those volcanics? I mean, so far we've only talked about them as sort of maybe an inconvenience that increases the depth of again by what you think is about a kilometer. But could they be more than that? Like, could this be sort of a bigger issue in terms of drilling difficulties or how strong the rocks are and losing holes or stuff like that?
You know, the volcanic rocks aren't a terrible thing. Quite often, good porphyry deposits are hosted in volcanic rocks. But in this particular case, we feel that the carbonate rocks are a better host for the ore. At least that's based on our observations from other showings in the area. The carbonate rocks make the best host for ore. Some of the old holes that were drilled back in the 1970s, we were able to locate them and actually go out and you can drop a pebble down the open hole and you can hear it rambling toward the bottom. It takes about 20 seconds for the pebble to get down to the bottom of the drill hole. So it's open all the way down. So that's a pretty good indication after over 50 years that a drill hole is still open. That's a pretty good indication that you got good drilling conditions. So we're expecting the drilling should be fairly favorable.
Right. So, but you said you don't have that core, because I was just thinking about how but you're talking about what a potential good host might be for mineralization. I was thinking about how the mineralization might have been distributed across the different types of fragments or layers that you have there, but I suppose you don't have access to that data either.
Yeah, we don't have all that old data, but you know, this is a area of science where we actually have to gather every piece of evidence that we can get our hands on to be able to try and create the entire picture. And you know, we do see a lot of really interesting things in the volcanics. For instance, the old timers put in a lot of small adits and shafts into the area. We went in and resampled some of those old workings, and we came up with one sample was up to 28 grams gold, which is really an interesting result. We don't see a lot of gold in this area, but there's placer gold in the creeks on the property. And we see this high-grade gold in some of the old workings. And, you know, this all fits in. Peter McGaw has a great geological model where he talks about the different metal zonations as you are at close to the heart of the system and then as you work your way out into the periphery. And in the upper and outer extremities of the system, you get into the gold silver part of the metal zonation. And so that's really encouraging for us to see this hopefully high level gold mineralization that could be related to the copper mineralization that might be lurking below.
Right. So enter Dr. McGaw's CRD checklist.
Yes.
Have you guys done that, or is that too early to do?
Oh no, we always keep that in the back of our mind, and you know there are certain obvious misses on that CRD. We're not on Main, carbonate replacement deposit Main Street down in Mexico, but there are a lot of CRDs that are in our area. And as a matter of fact, a lot of the porphyries that are in Arizona actually have, a strong CRD component to them because a lot of the host rocks are carbonates. And so it's really, and one of the best known porphyries in the world is actually a CRD system. That's Bingham Canyon up in Utah. That's actually the most complete CRD system in the world, with underneath the big open pit are hundreds of miles of tunnels where the old timers were chasing after the high grade zinc, lead, silver veins, and then out in the peripheries you get I think it's called Barney's Canyon. There's high grade gold and so on and so forth. So there's a continuum between porphyries and CRDs, and I think we're in that type of environment.
Right. Essentially, though, the depth of it all means that it's either going to be underground or a block cave. For an underground, you're going to need relatively high grade. Do you think the system, let's park the block cave assumption for a second. I want to go back to it, but let's go with the assumption that this has to be an underground. Do you think the system, the way it looks right now, lithologically, and in terms of mineralogy, do you think the system has the bones to support a high enough grade for it to be an underground mine?
Well, we're certainly in the right zip code for that. If you take a look at some of our neighbors, the mineralization that's in Arizona tends to be pretty high grade. As I mentioned, the first block cave in North America was at San Manuel, 35 kilometers to the south of us, 400 million tons of 0.7 copper. And so that sort of sets a good benchmark. If you can find 400 million tons of 0.7 copper, you should have a good block caveable mine on your hands. And then with Resolution just to the north of us, 1.6 billion tons of 1.6% copper. I know the Ray mine has got very high grade mineralization in certain layers within the mine. It's still operating 20 kilometers to the north of us. And I don't know what the overall grade is of what they're mining now. I think they're into the lower grade mineralization now, but in the past, a lot of the mineralization, the ore that they were mining was over 2% copper. So we certainly are in the right neighborhood to find high grade mineralization.
Okay. And if we can talk about how a block cave might work here, but what kind of grades would you need to support a block cave? Like, what are you looking at?
Well, there's a lot of variables that go into, what makes an economic deposit, but I would say that we've again stacked things in our favor being where we're at in Arizona. The infrastructure that's already there helps a lot. We don't have to build a road into our property. We've got a highway that bisects our property already. So we've got excellent access. We've got, good infrastructure nearby. You'd never have to build a camp at a mine in the location where we're at. People could go home and sleep in their own bed at night. And so that really helps with the economics for what makes a deposit. We have a smelter that's 2 kilometers away from the edge of the property. These are all factors that play in our favor in terms of the costs of operating a mine. So I would say that when you look around at comparatives around the world, remote mines in Chile versus block caves that have operated in Arizona, I would say that we would be closer to the lower end of operating costs if we were to find something of size at our place.
So in terms of grade, you're still talking about 1%, though.
That's a general rule of thumb, that if you're looking for something that's going to be an underground mineable situation, you'd like to have those kinds of grades. Yeah.
Okay. And then assuming, of course, recovery and all the other things are in your favor, is that too early to talk about? Obviously, you haven't done any metallurgical tests, but is that you probably have assumptions, right, in the back of your mind?
Yeah, I think that you're right in assuming that it might be a little bit too early to start talking about that. I mean, I'm a geologist and I always have these things percolating in the back of my head, but until we actually find something, there's no way that we could speculate on what the metallurgy would be like. But again, looking in the area around us, the metallurgy of the surrounding deposits all seems to be fairly good. They get high recovery of copper, and that's largely related to the fact that a lot of the deposits around us are relatively high grade, so that usually works in your favor in terms of metallurgy.
What was the concentrate well, it was a copper concentrate, I assume, that the Christmas mine was selling, but there was some gold and silver credits to it. Was that a separate circuit, or how was that done?
Yeah, there's a whole plethora of ways that the Christmas mine was processed. They actually direct shipped some ore in the very early days. At one point, there was a smelter that was on the property at Christmas. A lot of their ore went to the Hayden smelter, which is right next door. So there was a whole bunch of different things that were done. But in regard to the precious metal content, Arizona is an interesting place. Some of the deposits around Arizona don't have a lot of precious metal content, but if you go to other sections within, Bisbee and Globe Miami, both had a very substantial amount of both copper and silver. And silver is really interesting in Arizona because across the board, pretty much, many of the deposits that are in Arizona have a substantial silver background content to them, where you get this recoverable silver in the copper concentrate. So, but again, a little early to talk about. We need to get some drill holes down into the property before we can start talking about things like that.
That's the forward-looking statements we always talk about, but you're right there, Steve. Block cave, what else should we talk about? Oh, topography. How's topography? I saw that it's kind of a hilly region. I mean, there's hills all around. I can see it on the video. Is that going to be an issue for the block cave, for a potential block cave?
No, I don't think it'll affect the block cave at all. The engineers, they've got their modeling fairly sophisticated now, and so they can figure out how the various topography is going to affect the way a block cave propagates. But the hilly topography works in our advantage in a number of ways. And first of all, it gives us some outcrop. A lot of the dead flat areas you go into don't have a lot of outcrop, so you can't see the bedrock and do any mapping. In our area, we actually have a substantial amount of outcrop that we can go and map, and we've been able to find breccias. A large thing that one of the things that our crew has been concentrating on this year is actually getting out and doing mapping, sort of picking up the torch from where it was left off in 1970 when the last guy was out there doing some mapping for his master's thesis, and originally found these breccias, the namesake breccias for the property. And we've gone out and found those breccias that he was mapping, and we've actually been able to find more as well. And we've done a lot of detailed mapping of the fragments that are within those breccias. We've sampled some of the skarn mineralization that's in the breccias. We've received assay results up to 5.5% copper in some of these fragments that are getting ripped up from down below. And so it's been a really useful exercise for us to go out and do the surface mapping. So we're glad that we've got topography from that perspective.
Right. Okay, fair enough. Yeah, I think that gives me a better idea of what the potential is for a block cave here. Too early to talk about all this, maybe, as you said, though. So let's talk about drilling, which you hope to do this year. You said 5 holes, about 1,000 meters, 5,000 meters. What is this, BLM land, I assume?
Yeah, that's correct, yeah.
Okay. How's permitting going?
Permitting is going well. We've received some questions from the permitting agency that we were able to answer them with ease. And so I don't see any complications with getting the permits. As a matter of fact, we're expecting that we should have the permits in hand any day now. So we're hopefully nearing the end of that permitting process to get the diamond drills permitted.
Okay. There's not that many drill pads that you've applied for, I don't assume.
Yeah, I think it was 10 or 12 drill pads that we actually permitted, and we've tried to concentrate the disturbance in areas that are already disturbed, and that really helps out a lot when you're going through the permitting process. And that's one of the nice things about working out in the desert like we are. The drill roads that were built over 50 years ago to support the drilling that took place back in the 1970s, those roads are largely still in place. So we need to go in and do a little bit of maintenance and clear some of the boulders off the top of the roads and things like that. But they're in pretty good shape. So that's really an advantage.
So you can still use those historic rolls. You don't have to fly in the drill.
Oh, that's correct. Yeah, we'll drive the drill into the site and use a track mounted drill so he can get around to wherever he needs to go.
Good. How much is that going to cost then? Because you said it's expensive, but given that it's not helicopter, I don't assume it's too expensive. How much are you looking at?
Yeah, we never know until we actually sign a contract. The diamond drill rates I've found in Arizona are highly variable, but we've started discussions with a handful of contractors, and early indications are good that the diamond drillers are hungry. They've got some rigs parked in the yard, and we expect that we're going to get some aggressive pricing. And so we're budgeting for $500 all in to be able to conduct a drilling program.
That US?
US.
Okay, so that's $2.5 million that you need US to go and do this campaign all in.
Yep.
You were spending 90, as I said, a month. That's about $1 million on administrative expenses, unless you're looking at an increased G&A spend. Well, are you? I mean, are you looking at an increased G&A spend this year?
Well, yeah, we are looking for an increased G&A spend, but I think that your estimate of 90,000 a month is a little bit high. That would be when we're active and we're doing a lot of exploration work, so that would be included in that $500 a meter. I would say without doing anything, our G&A is more like 300,000 a year. We're a very low overhead company. We don't have permanent head office. Nobody's on fixed salaries. We get paid when we work. We don't get paid when we're not working for the company, and we all have other clients. So it's a low overhead scenario for us. So we're pretty lean and mean, I think is the way to describe it.
But where I'm coming from with this is that you're basically going to need 3.5 total-ish to complete everything. I mean, with marketing and office and the work, because if you're doing 5,000 meters, you're going to be relatively active. So you need the team. You're going to be paying the team. So what do you need? Like $3.5 to $4 million US, basically, to get through this drilling.
We'll go out and do a $3 million raise Canadian,
okay,
and that should suit our needs in the immediate term.
That's exactly where I was going with this. I was going to ask you, how do you plan on raising that money? Who do you plan on raising it with and stuff like that? But it's interesting that you just, I mean, straight up say we're going to go out and raise it. Because as I mentioned at the beginning, the Vizsla shares you own are now worth about $1.7 million Canadian. Why not sell them, drill like 2 holes, and then come back to the market with those results and raise in the back of that at a higher market cap, potentially?
Yeah, well, that gives us a great optionality to be able to have a liquid asset like those shares. We are strong believers in our neighbors, and we're part of that entire play, and we think that that's an investment that we might be able to capitalize on, by actually hanging on to the shares for now and maybe liquidating them at a little bit further down the road. Right now, I think the idea is we've been very careful with our capital structure. We only have about 45 million shares outstanding. And at this point, it would be good to bring some more investors into the play to get involved and help with our liquidity. And what we're considering for our first phase of diamond drilling at Hot Breccia is a relatively limited in scope. And the idea there is that we go out and do this initial program. Hopefully on the back of that, our share price would go up and we'll be able to finance the next round on the back of a higher share price.
You also have the property payments that I mentioned at the beginning for 20. Is that, what's the timeline? Is that end of 2024? Is there a different date on it?
Yeah, it comes at the end of the year.
Okay, fine. Good. What about, but then again, you just answered, I mean, you just want to go for traditional capital raise. Is there no other option? I mean, the price is not where you want it to be, I assume, when doing a capital raise. Like you would prefer it to be higher. So aren't there any other options? I mean, you have the 2 other projects. Arguably, you're not getting much value for them in your market cap either. Could you monetize those in order to pay for drilling on Hot Breccia? And is that something you'd even want to do?
Well, I think that one of the rules that I've learned over my career is that when you've got a good property, hang on to it for dear life. And I think that we really have 3 good projects in the portfolio. The Palos Verdes project is, definitely strongly linked to Vizsla and their project that they've got down in the Panuco district in Sinaloa state in Mexico. And I would say that at some point that property, it's probably going to make sense to sell it to Vizsla, but we need to make sure that we maximize the value of that. And that's going to take the form of actually doing a drill program this year. That'll happen in 2024. We've actually got a program that we've designed with Vizsla, and we're going to go out and drill about, it's going to be about $350,000 worth of drilling this year to see if we can get down a little bit deeper on the veins that are on our property. And then the second property that we've got in Mexico is a relatively early stage orogenic gold belt, and we've actually done quite a bit of work. The initial round of drilling was very successful, and we actually proved the existence of an orogenic gold system there. We had some great results, 6.5 meters of over 10 grams gold with some silver. And I think we need to step back, make sure that we approach that project from a very systematic process. We're going to be going out and doing some groundwork, mapping, prospecting, some ground-based geophysics, and so on, to make sure that we maximize the value of the next round of drilling that we would do there, probably in 2025.
What I'm hearing here, and correct me if I'm wrong, but it's a $350,000 spend equals a sale, equals a potential sale. Again, a forward-looking statement. But is that too simple of an explanation that I'm giving here?
Sorry, the $350,000 spend to do what?
To equal a sale, to be, well, you're going to go and drill this $350,000, and then what comes out of the ground could be enough for you to eventually go to that, what you call some point where Vizsla takes it over.
Yeah, I mean, I can't speculate too deeply on exactly what path that process is going to take, but what we're trying to do now is create value through the drill bit, and we want to be able to fully assess the vein system that we've got on our property to make sure that we're going to be able to maximize the value to shareholders. And obviously, with the size of the property and the success that our neighbors are having, it's probably going to make sense to incorporate our property with theirs in some form.
Yeah, I think that's a fairly reasonable statement. I have been very, very forward-looking today. Typically trying to be less forward-looking, but I mean, trying to figure it all out. Okay, what else? What do you have? The Sonoran. I didn't look too much into it because I don't think there's too much happening. But what's happening there this year?
On the second Mexican property that
Yes.
we've got? Yeah, that's Los Pavitos, and it's a great project because it came in through Peter McGaw when the company was originally founded, and it was an idea, right? There's an orogenic gold belt that stretches all the way up into California and then comes down through Sonora State and into Sinaloa, and we really felt that we were on the right trend there. Went out and did some basic work on the ground, and then conducted the initial diamond drilling program. And then when we came up with that drill intercept that I mentioned, over 10 grams gold, over 6.5 meters, I think there was 35 or 45 grams silver as well in that intercept. This is proof positive that our thesis is correct. There is an active orogenic gold system there.
Yeah.
And it's a big property, so it's going to take a lot of groundwork to actually get the crews out on the ground and do the hard work, the boot leather on bedrock, I call it. And that's how mines are found, is doing that part of the exploration process. Now, it's the cheapest part of the exploration process, but it's also the most important. And so we want to make sure that we don't skip over that. And so that's largely what's going to happen in 2024 on that property, is getting some crews out on the ground, making sure that we do some mapping, prospecting, ground-based geophysics, and then trying to get it set up to go to that next phase of drilling.
Okay. Chronologically, how do you work these three projects? As in, when do you start drilling on Hot Breccia? When's the other work in Mexico happening?
Yeah, well, that's one of the reasons why we recently expanded the management of the team, of the company, is because we needed to have a bigger team to be able to handle all of this. And so the fellow who was Craig Gibson, one of the founders of the company, was formerly the president and CEO of the company. Now he's the chief exploration officer, so that he can dedicate all of his time to making sure he manages the exploration that's going on in those three projects. And I would expect that our first priority is going to be to get the drill turning at Hot Breccia in Arizona. So hopefully if permitting and financing works in our favor, we could actually have a drill turning by the end of June on that property. The exploration that is going to go on down in the Panuco district, we'd like to have that underway this summer as well. So, that might have a little bit of flexibility. It's not a big program, so we could delay that into the fall, but we'll see how all the chips fall into place for that. And then the Los Pavitos property, we're going to be going out and doing the groundwork in the fall, I would expect, and trying to set ourselves up for a drilling campaign in 2025.
Yeah. It's interesting that I met Craig at PDAC earlier this year, and then when I came to Germany, I met you guys. So it was you and Alain, and I was like, "Where's Craig? Who are these guys? I don't know these guys."
Right.
So but it's been good to see how the team is strengthened. You essentially, your other company is optioning this project out to Prismo here, right?
That's correct. That's originally how I got involved. I was the former, or I am the former CEO of a company called Infinitum Copper. I'm currently the chairman of that company, and we just had too many things going on for the weak market conditions that we were in at the time. We couldn't continue to finance our activities down in Mexico as well as fund the Hot Brecha project. So we optioned the opportunity to earn 75% to Prismo, and then the guys, I got along fairly well with Craig and Alain, and they asked me if I would help them out as a consultant and an advisor, and so that's originally how I got involved in January of 2023, and then we got to the point where we're at now, and I just joined the company as president maybe 3 weeks ago because the things are starting to heat up with all three projects in the company and Prismo, and it was decided that Craig couldn't continue to do everything that he was doing as president and CEO, and so I was asked if I could come in as president. Alain switched from his previous role, which was executive chairman, into the CEO role, and I think that we've got a much better structure now to be able to carry things forward.
Yeah, and even though I only met Craig once, it seems like he prefers talking to rocks than talking to people. So it makes sense.
He's got his PhD in geology, and very well deserved. He's a brilliant geologist, and I just love working with Craig.
Yeah, and there's also zero promotional speed going on with him too. Speaking of which, what are you guys going to change in terms of promotion? I mean, again, I mentioned you were a PDAC. I see you're working with a couple of online things. You did someone's running your IR, I believe. You signed recently a contract, 6-month contract, not too long ago. You're going to conferences. What's the marketing plan to tell the story here?
Well, I think marketing, we don't want to have the tail wagging the dog. And so you don't want to go out and market if you've got nothing to talk about. But in our case, as we've just been talking about for the last half hour, we've got some very exciting projects. And in particular, with the activity that's going to take place with Hot Brecha, we think that we're going to need to be able to communicate our results to the market effectively. And so when you see this coming down the pipe, natural response is to go out and start beefing up your opportunity to get your message out. And so that's our intention, is to get ourselves well set up so we've got good communication protocols in place. And then when we start to get the drill results rolling in from Hot Brecha, we'll be well positioned to be able to tell everybody what it is that we're seeing down there.
Okay. But I'm looking at this. This comes from the news release of March 26th that you've taken an IR firm. That's 120 grand for 6 months. What's the goal of this? I mean, where's this money going in?
Yeah, so these are the types of things that you need to do when not only you're going to be getting results and so on, but you also have to go out and raise money. And so, we've obviously got some cash needs, funding needs that are coming up, and so this will all help in terms of communicating with the market, being able to facilitate the financing, and then to get the news out to the market so that people can hear about the good results we're getting.
Okay. Do you have any idea, because you say you want to be drilling by the end of June, which is fairly aggressive, about a month away from now, actually. Do you have any idea as to who you're going to be raising this money with? I mean, does management plan to keep that 10% ownership? Have you spoken to Mike over at Vizsla? Does he want to keep that percentage of ownership in Prismo? And how's all that going to work out?
Well, our expectation is that I don't think Vizsla is going to want to fund drilling that's going on up in Arizona, but Vizsla has expressed interest in continuing to fund work that's going to go on down in the Panuco district, and we'll continue to explore that with them as we get closer to the drilling date for that property. So in terms of the other sources of funding, I mean, that's why we're over in Germany. We were also in Switzerland and Brussels and London. We just came back from Southern California on a trip, and so we're trying to engage with as many solid investors as we can. We're trying to target those types of investors that we know are long-term holders and people that like to get involved in a story and follow it. And this is the time to do it. With copper reaching all-time highs, people are looking for the big copper exploration stories, and this is truly a swinging for the fences type exploration play at Hot Breccia. And so it's really resonating well with the investors that we've been talking to. A lot of people are very excited about it, as we are. And so I think this is a great time to be going out and talking to the investors.
Okay. And then do you think that, what did I say, about 30% of the company is owned by management? Do you think that's going to remain the case as the company grows? Or is that the expectation?
Yeah, well, management is certainly going to continue to be invested in the company, and I mean, I just joined the company 3 weeks ago. I'm currently building a position in the company and want to maximize my exposure to any future success that we might have. And so I believe that the mindset of management is to continue to hold a strong position in the company. It's going to become more and more difficult to hold that position, of course, as we grow. But we are believers, and that's why we have structured the company the way we have: low overheads, no fixed salaries, and so on, because we want to align our interests with the other investors and make sure that we benefit in the same way.
You mentioned that you recently joined the company. You're now building a position. I saw that Alain is also building a position, step by step. You can see it in the SEDI filings. You also have a couple of other positions in other companies. I believe you're involved in, as I mentioned, in Infinitum, which is the option holder here. And, no, you're the option holder. They're optioning it to you. And then there's another company, Cassiar. Is that Cassiar Gold?
Yeah, I'm on the board of Cassiar. I'm also
Okay.
an advisor to that company, and that's an exciting project. Not a competitor to Prismo in any way, which is kind of nice. It's a different part of the world. We're up in northern British Columbia with a high-grade orogenic gold play up there, and it's a nice company because they've taken a historic district and consolidated this, very patchwork quilt land position into one large package, and we can now take a district scale approach to the exploration on that project. So it's a good one to be involved in. Good people there as well.
How much of your time goes into those three companies? I mean, are those the only three companies? So Prismo, Infinitum, and Cassiar, that's it, what you're doing on a daily basis, basically?
I'm also involved in another company. I'm on the board of a company called HEREIN Gold, which is working down in Nevada and in Mexico as well. It's really variable in terms of where my time goes on a daily basis. And obviously, Prismo is going to get a lot of my attention going forward. Cassiar is pretty active right now, and so I'm spending a fair bit of time on Cassiar as well. HEREIN Gold, not so much right now. So it depends on where the need is. But clearly, Prismo is going to take the bulk of my time going forward from here.
Right. Okay. Good. Well, Steve, I've been through a lot of the questions that I had. What am I forgetting to ask you, though? What did you come here hoping to talk about that I'm failing to bring up?
Well, I was expecting, quite frankly, that we would spend a little bit more time talking about the coming frenzy in the market. I just, I see all the stars aligning in regard to metals markets, but in particular copper right now. And this is just such an exciting time to be exploring a project like Hot Breccia, which I really think is a world-class opportunity. I've been exploring for copper my entire career, and to have a project like this at a time like this is just a unique alignment of the stars, and very exciting time for Prismo.
Do you think that's gonna help you in any way? I mean, do you think that there's going to be a noticeable difference in the share price between today and the time you have to raise capital because of the state of the macro, though?
Well, I think that we have a tailwind at this point, but it's still up to us to come up with results. Like, the stock price doesn't go up by itself. And so we need to continue to work with the market in terms of our communication and actually tangible results. And so we're going to have a number of catalysts ahead of us. The first of which would be probably announcing that we've received the permits for drilling down at Hot Breccia, and on the back of that, we'll hopefully start drilling and continue to feed good news out into the market, and that's what's going to raise the stock price.
Good. How long do you think, by the way, is going to take you to drill those 5 1,000-meter holes?
Well, they're deep holes. My experience is that kilometer-long drill holes will usually take about a month to drill.
Okay.
And so, I think it would take us, if we start in June, it was effectively going to take us the bulk of the rest of the year to drill that initial program.
Right. Because, again, not a geologist, but as far as I understand it, those volcanics are denser rocks than what you would normally drill in Arizona. And so I thought it might take longer, but a month is good. For all 5?
No, a month for each hole.
Oh, a month for each hole. Okay, good.
Yeah.
And then you're going to be announcing it hole by hole, then I assume you're not going to batch them.
We'll announce them as we feel fit. I think that if it's taking us a month to drill each drill hole, you don't want the entire fate of the program to hinge on the results from one drill hole. So
Sure.
I think we'll reserve our opinion on how we're going to release them until we see the results come in, and we'll release them as we feel it's necessary. And certainly, if we've got material information, we'll make sure that we get that out to the market. It takes us probably about a month to get the assay results after the hole is drilled as well. So from the first drill hole, if we start drilling, say, at the end of June, we'll start getting those results in September, which is probably pretty good timing, because that's quite often when the market is most attentive to drill results.
Right. And September, that would be end of September, I assume, because you have to drill it, send it to the lab 4 to 6 weeks, and get it back. So end of September kind of is where you're expecting assays.
Yeah, I think that's a reasonable expectation.
Okay, good. Good. Well, Steve, I'll be following along with this interesting story, and I hope we can do this again soon once you have maybe the permits or the clear targets that you announced as to what you're going to be drilling. But yeah, this was a good overview. Thank you so much for investing your time with me.
Yeah, I really appreciate the opportunity, Antonio. It's been great, and I look forward to being able to update you as we progress along.